feels like they're sort of locked in for this July hike.
If the inflation rate bottoms at 3 and starts drifting higher, the Fed's going to find this unacceptable.
Disinflation without a downside in growth, without an upside in unemployment, is the Goldilocks soft landing narrative.
We're expecting a soft landing, but that may be harder than others are thinking.
We might see a recession that might be mild.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Ciao ragazzi. Buongiorno, buongiorno.
Oh, there we go.
This is the audition for Bloomberg Capri. You know, you on board?
I have no
you want to make
life.
that happen?
I would love to see that. Folks, life, for those of you on radio, I'm pointing
and then
at Mr. Ferro.
What have we got on the other side? What's this?
Get a life.
What's this?
Get a life.
Live from
Hot
New York
dogs
City
are great.
this morning.
Sauerkraut.
Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro. A belated happy 4th to all of you stateside and welcome back to work. Futures just about negative by 0.5% on the S&P 500. TK, big week ahead. Payrolls on Friday, then the last CPI print before the next Fed meeting, just around the corner.
Big week ahead. It's Wednesday. I think the week really starts there. Thanks to Katie Greifeld for killing it on Monday with Ellen Zentner and other worthies. But you're right. It is a wicked holiday shortened work week. Wednesday, Thursday, Friday, all that economic data, none of it matters because then we got to get to the inflation report before the Fed meeting. We've heard this script before.
And then earnings begin. I think a lot of people starting to price in a hike from the Federal Reserve in July. TK, with very little data between the last meeting and the next meeting. Ellen Zentner and Morgan Stanley setting the bar, actually, for what we'd need to see on payrolls on Friday to take that hike back. Something below 100,000 on payrolls on Friday. And a soft CPI print as well next week.
She said that, and we're distant from that. We're distant from sub 100,000. I mean, do you get there suddenly, or is it a gradual move? And I'd like to see 180 or 170 before I worry about under 100,000. But, I take the point. And while you were gone,
how many times are you going to do this morning?
While you were gone in your sabbatical, a host of characters and myself decided that earnings really matter. July 14th, it matters like it's never mattered before.
JP Morgan coming up soon. We need to talk about the data out of China as well. Tom, we know about the weakness worldwide in manufacturing. It's about how manufacturing converges with services over the next several quarters. The weakness in China overnight. In services, TK. We've seen the weakness in manufacturing in the United States. We've seen the robust nature of the data on the services side in America. How does that converge over the coming quarters? That, of course, is the secret sauce. It holds the key to the inflation debate, the recession debate of the rest of this year.
Leland Miller lights out a few days ago with China Beige Book, and he agrees with a caution on China, but he says it's a domestic international partition, and domestic China's actually doing better than the gloom. He does take the point that manufacturing there is a huge challenge. Renminbi this morning, 7.24. Really, FX is pretty quiet all in all.
Should we get to the price action? Futures a bit softer this morning. Let's whip through it. Let's have a look at the bond market. The 2-year yield came really, really close to a 5 handle on a 2-year yield in the last week or so. Backed away since then. Backing away on the 10-year this morning, down a couple of basis points to 383.70. In the FX market, year to date, the euro averaging about 108. Not a million miles away from that number right now, Tom. At 108.91. Just about positive on that currency pair by 0.1%.
Range bound, most of FX didn't move since you were away, but foreign exchange, I'm sorry, has a lot more value to me right now than the FX analysis. We've come back a little bit from the shock of Friday and Monday, but 210 spread out to 110 beeps. We're at 105 beeps still. That's a jaw-dropping number, even with what we saw Friday.
In triple digits is amazing, TK. You go back to where the 2-year was, cycle high of the year, 5.08%. Yeah. Right before the banking malaise of March into April. And we've taken it all back since then over the last couple of months.
It's a toxic brew. And I'd look at the 10-year real yield, which, John, you literally followed tick by tick, 1.58. It was 1.62. And again, we've eased off on a Wednesday here, and maybe it's that setup before the jobs report.
Here are the scores year to date going into the second half. The Nasdaq 100 up 39%. The S&P 500 up by 16%. And remember in the first half what we were told coming into a new year in 2023. The first half we would dip, and then the second half we would rip. And then the first half it was like off to the races, just like that. Jonathan Stubbs joins us now, equity strategist over at Berenberg. John, for a lot of people, waking up, missing out on the rally, looking ahead to the second half, asking, what on earth should I do? What should they do?
Well, I mean, the dip and rip hasn't happened. It's been more sort of rip, as you say. European bourses, DAX and CAC are plus 50% in dollar terms from their sort of autumn 22 or fall 22 levels. As you say, Nasdaq's up a short 40% year to date. So we've seen some phenomenal gains. That's been driven by three things: GDP upgrades, big ones from economists, 1.5%, 2% added to global US, European GDP expectations for this year in a couple of quarters. Earnings resilience, number two, and the dollar liquidity globally has been very supportive. Now, looking ahead into the second quarter, we need a new narrative, or we need an extension of that. We find that hard to see here. So perhaps instead of the dip and rip, we get the rip and dip.
John, just to build on that a little bit more, are you suggesting de-risking, and how are you suggesting people should do that?
Yeah, we wrote a note last week, which was titled sort of Crash Protection, which was partly looking at some of the risks in markets, but also looking at active protection strategies. Now, again, the US is center of attention. The US equity market remarkably is heading towards 20 times forward earnings. Again, we've only been higher than that twice in 50 years when we've had liquidity-driven bull markets, TMT, post-COVID, etc. US tech against global equities now an 80% PE premium. Historically, you've had 100% 12-month forward lose ratio owning tech at these valuation levels. So it has to be different this time. That's one option. Otherwise, you're looking for active protection. We quite like energy here because of the balance sheet strength, the free cash flow, it's unloved, and we'd pair that against industrials to get a nice active sort of hedge within markets. But we think markets are trading at risk as we go into the rest of the summer.
Jonathan, can you double barrel the relative valuations on a PE basis and also with the energy sector? I'm really taken by the U.S. valuation, called a blended 19 PE, and you published that you've got UK equities at about a 40% discount, 10.6 PE as well. While we're afraid of U.S. stocks, do we want to buy United Kingdom FTSE?
Yeah, I mean, it's a good point. I mean, the US clearly is the monster when it comes to equity markets, and keeps on growing. The UK is a relative minnow, but that valuation gap is historically wide. We think that gives the UK some resilience as we go into some sort of global macro market headwinds over the next couple of months. And when you look at the fundamentals within the UK corporate sector, balance sheets are strong, cash flow is strong. So it's a market that's unloved, partly for macro, partly for political headline reasons. That doesn't necessarily change overnight, but we think at these levels we're certainly getting a good offer out to international investors to come and look for a cheap and still big equity market. So we've been sort of banging the table on that valuation spread for sure.
What is the distinction between U.S. big oil and EU continental and UK big oil?
I guess what we've seen over over the whole energy space over the last few years has been increasing pressure from the green machine, from the sort of the ESG lobby, and that's sort of changed different companies, different sort of sub-industry groups in different ways. We started seeing a little bit of a pushback over in Europe from at least one of the majors, which is sort of heading back to sort of grassroots, shall we say. And when we look across energy in general, US, UK, Europe, it really doesn't matter. As long as we find strong balance sheets, and some of these companies are close to net cash, as long as we find high free cash flow yields, and some of these are in the teens free cash flow yields, we're seeing a combination that looks attractive.
Yeah, but tech has the same combination of free cash flow yields. I get that tech's at a premium, but don't they have a growth model that's far superior to energy?
Yeah, correct. And then it's a valuation. So my valuation point earlier, we're at a point for tech where historically it's been right to lighten up exposure. They've had an incredible run, so that's point number one. Number two, the technicals within tech, just looking at RSIs and breadth and everything, suggests the same thing. Number three, tech. Remember, tech has rallied this year, this monster rally against a backdrop of 10-year yields heading sideways. So, to say from today we're going to get another leg on the tech rally, really, given the macro relationship, we should have 10-year yields collapsing. And that's sort of macro negative in the US, and that's probably also risk asset negative and leadership negative, which is tech leadership. And the final point on fundamentals is that technology, US tech was awesome, post GFC, because it had an additional surplus free cash flow premium to the S&P, and also a big yield pickup, however you measured it, to 2-year money. Now it has neither. So we argue that the fundamental leadership supporting tech is also gone.
Shout out to Neil Dutter of Renaissance Macro, who's been all over the home builders over the last 12 months or so. Jonathan, let's just finish there. The home builders in America on the S&P 500 are up 41% so far this year. The two-year yield is close to 5%. The Federal Reserve is threatening to hike more. What evidence is there that monetary policy is sufficiently restrictive with home builders up something like 41% plus?
Well, it's we've all spent a long time now looking at sort of yield curve relationships, deltas on rates, the fastest sort of tightening we've seen in the last 3 months. We've seen an additional 100 basis points added to 12 months out short-term rates around the world, and the market's been incredibly resilient around that. When those facts alone suggest that central banks haven't gone far enough at this point in time, so they need a lot of help from inflation. If we are to see peak rates anytime soon, they need even more help if we're going to get a traditional significant fall in rates over the next 2 years. So markets are suggesting that perhaps the central banks will have to push further or remain higher for longer. And that's a headwind that markets have to digest, we think.
What a move. Jonathan, great to catch up, to kick off the week with you. Jonathan Stubbs there of Berenberg, as the US gets back to work with futures slightly negative off the back of weaker data over in China. Look at some of these cruise operators in America. Carnival up 67%
Is that what you did?
in June.
Did you go on a Carnival cruise?
Me on a cruise. Do you want to talk cruises?
Jeez.
You'll never catch me on a cruise.
Have you been?
Never.
People that
Never,
do it
ever,
love
ever.
it, love it. I've never done it.
It's a thing.
It's
it's not a thing for me. Can you imagine being trapped on a boat together?
I can't
like
even
2
imagine
weeks.
3 hours.
For 2 weeks.
Continue.
I'll take a hard pass on that. But stocks are doing phenomenally well.
They're doing well, and you mentioned here, we get back to work, and that's what America does. And you sit there and look at the shock of the first 6 months of 2023, and as I said, corporations adapt. We get back to work, we adapt. The great trend for me, Jeff Curry nailed this at Goldman Sachs, is this new rate regime, which is 16 years old, affects everything out there, including the banks. It affects this new rate structure, affects everything. And because of that, people have to get back to work.
Who's paying it? Who's paying 5% right now? Great study from the team over in the UK here at Bloomberg on this. Take a listen to this, Tom. This is some data for interest rates in the UK. Who's paying it? Who's receiving it? At current interest rates, savers collectively are earning 24 billion sterling more a year than in November 2021, the month before they start hiking interest rates. Okay, mortgage borrowers are paying 14 billion more in debt interest. So at the moment, it's almost a net benefit. Now, Tom, as time goes on, and as a lot of people start to see their mortgages and their agreements with those banks need to be renegotiated again, then it's going to kick in the other way. But currently, that's the story at the moment in the UK, and I think we'll have a similar conversation stateside too.
I think it's everywhere, and the key phrase there is as time goes on, we adjust out, and I'm going to suggest that American corporations can adapt better than anyone. It's not for me to be bullish or bearish, but the humbling nature of this rally off the October bottom, I don't hear many people setting up a second leg of a bull market like 1975-76, which was a shock. No one expected that.
Do you want to talk payrolls quickly? 225 is the estimate
for
Friday.
The number?
225. That's going to be a moving target as more estimates start to pour in, but that's the medium right now in our Bloomberg survey, 225 from a previous read of 339. Yeah. For those of you interested in the unemployment rate, the estimate there, Tom, 3.6%. Looking for that to drop from 3.7.
Tomorrow, Thursday, we conflate continuing claims, always on Thursday. Jolts, we get there. We get ISM services, and we get ADP all together tomorrow.
Tons this week.
Well, it's a short week. It's
then next week into CPI and bank earnings too.
Colonies won.
The Colonies won?
Yeah, watch Poldark.
What does that mean?
They filmed it out where Tori Amos
The Colonies won. What are you trying to say?
Colonies won. Poldark fought. Poldark was brave.
Okay.
Came back home.
You like Poldark,
married a girl with red hair like Tori Amos.
You're still watching Poldark?
I watch it, yeah. Mrs. Poldark's, she's like Tori.
Oh, you like Poldark?
Yeah.
Nice.
We can work with China on various issues, but they're also a competitor, they're also a rival on many other issues. But I've been advocating for a comprehensive European approach vis-a-vis China. So we don't want to decouple, and frankly we cannot decouple, but we want to de-risk.
Kyriakos Mitsotakis there, the Greek Prime Minister, with the brilliant Francine Lacqua of Bloomberg. An exclusive conversation over the last couple of days. TK, that line there, a comprehensive European approach towards China. How difficult is it going to be to get one of those?
I think it's going to be a huge deal because it's Europe. And you know, what I noticed over the weekend in the reading, and this goes, of course, to the French riots and all that, is the French-German polarity right now of a successful French. Ambrose Evans Pritchard captured this beautifully. Germany basically flat on its manufacturing back. If those two can't get together, how does Greece help out with a China dialogue?
And you've seen Macron the last couple of months on the China front, Tom, making a bit of a fool of himself abroad, embarrassing some of his peers as well within Europe, with domestic issues really blowing up in his face at the moment too. It's very strange to hear some of the comments from the Chinese leader at the moment, Tom, the leader of the Communist Party in China, saying that he calls on all nations to reject decoupling and severing supply chains. And those comments follow real action. China's decision to control the export of two key metals, some of which go into chips.
The metals thing is a huge
That's massive.
deal. It's a massive, massive deal for it. I was reading on nickel somewhere over the weekend, and maybe that's the thing. You know, it's not wheat. It's not, you know, other things we talk about and the dynamics of it, but maybe it is the metal issue.
Yellen leaves today, right?
Is it today?
I believe so.
Amory Horton on this. Well, you were going to Amory Horton.
We'll catch up with MH a little bit later on.
She was working an 8-hour day. I mean,
she went the fourth.
I was watching, was it Reds Nationals this weekend? I swear I saw her behind home plate.
And that's work.
You know, it's work, yeah.
At the baseball.
Yeah, she's out there. She's out there with somebody from the Pentagon. I don't know.
Who won?
The Reds are killing it. Reds are the most fun team. I don't know who the football equivalent is, the soccer equivalent.
Okay.
The Cincinnati Reds are just fun.
What about the Red Sox?
The Red Sox, we don't want to talk about. I mean, it's painful. It's really painful. The Reds, their average age is 24. They're so dumb they don't know how good they are. They got Joey Votto as a senior guy. And, you know, Greg Vallier's going, why are we talking baseball? We got to talk China. Greg Valliere with us to save us here. Someone from New Hampshire knows nothing about Johnny Bench, Pete Rose, and the Reds of the 70s, and Joe Morgan. Greg, good morning to you. Yellen goes to China. Does she have the same energy about the trip as the Prime Minister of Greece does?
I think she has a lot of energy. And Tom, let me go out on a limb and make a fearless forecast. This will be a fairly successful summit. I mean, they're not going to cut explicit deals on semiconductors. That would be way too optimistic. But I think they have a very good dialogue. They set the table for further talks this fall, including a Xi-Biden summit later this fall. So I think when she leaves, it'll be viewed as a pretty good summit.
We're very U.S.-centric on this. To me, Greg, the whole thing is the urgency of Beijing to communicate, whether it's to Greece or to Athens or Washington. What do you see as the new urgency for China to speak to Yellen?
I think the new urgency is that their economic data has been awful. It's been sputtering. They have not really come back from the post-pandemic slump. And you've got to say, in the U.S., we've got two news stories that make our economy perhaps a little soft. One is growing labor problems. Hasn't gotten enough publicity, Tom. We've got some real labor problems. Southern California hotels, UPS. And we've got a real drop, I think, in real disposable income because of the student loan repayments which start in the fall. So our economy could use a little boost as well.
Greg, before we get to all of that, and before we speak about the US economy, can we just sit on the latest decisions around trade from China and potentially from the United States as well? We understand that China is going to restrict the export of some metals, and perhaps you can weigh in on that. There was some reporting yesterday from Dow Jones, from the Wall Street Journal, that maybe even there'd be some restrictions around access to cloud computing too. Greg, what's your read on how severe some of these decisions might be?
Well, they're talking tough now, but I think maybe they could get it watered down a bit when they have the meetings. I still think the biggest problem of all is chips. Computer chips is a big issue. The U.S. has not relented. We still haven't relented on the Donald Trump tariffs. So I think the chips issue may be the biggest of all.
This word de-risk, Greg, what does it actually mean in practice? They're very, very keen, particularly in Europe, to say this isn't about decoupling. This is about de-risking. What does that mean?
Well, first of all, there's big currency issues, and I think that the Chinese may have to offer some assurances to Yellen that they won't continue to weaken the renminbi. I think that would be a big deal. Plus, there's all these loans that third world countries have from China that China has not restructured, and I think that's a big risk as well.
I mean, Greg, part of this is the travel, and it seems to me like every president, we have a president now enjoying the distraction of international affairs. Over a painful 4th of July weekend, what did we learn about our domestic politics? Set us up for July, August, if we dare say America will get to Labor Day.
Yeah, I think that it's going to heat up quite a bit. Although, to my surprise, Donald Trump did not campaign during this holiday. Biden barely campaigned.
Yeah.
So it's left up to a lot of second and third tier candidates. The Republicans are going to have to start winnowing down the field. I think they're up to 12 or 13, maybe 15 if you
Ferro
look
may
at
jump in,
shots.
maybe throw his hat in the ring.
To the Republican field.
Really.
Go for the Italian vote.
Greg, what's going to drive that? What's going to drive them actually getting around a table and saying some of us need to drop out? Why would that happen anytime soon?
Oh, the polls, John. I think the polls will show that people are just wasting their money and time running. If you're at 2% and you haven't raised much money, I still think that Chris Christie will be a player. I think he is so blunt and actually kind of fun to watch, but I think he's going to stick in this race for quite a while.
So, Greg, first debate, I think, is next month. Is that right? In August?
Yes, late August, yep.
With Fox, I believe. Greg, how many people do you think are going to be on that stage?
Probably a dozen. And most interestingly, maybe not Donald Trump, who may feel he's got nothing to gain and everything to lose by being in a field that big.
Interesting, Greg. Just build on that a little bit more. You actually think the former president won't go on that stage in August?
Well, he loves publicity. We have to concede that, guys. But at the same time, I think he might feel that he would get just lost in all of the babble that will go on. If you're up by 30 points, which he is, well, why take a risk?
You're up by 30 points, but Greg. I think we're missing something here. I don't even have a summary of the carnage by guns this weekend in America. I got a geography of, I think it's Philadelphia, someplace down south. It's almost like, Greg, and correct me if I'm wrong, we've become benumbed by where we are in our domestic politics. Is it going to be a benumbed campaign?
Well, for now, Tom, we're in an odd-numbered year. So in an odd-numbered year, you have New Jersey and Virginia, and that's about it for gubernatorial races. So this is not, in my opinion, surprising. I think the issues, though, are going to be fascinating. All the shootings we had this weekend, China, lots and lots of issues I think will be interesting for us to talk about. But you've got to get that field, that Republican field, cut in half by the fall.
Greg, awesome to get your input on this. Greg Valliere there of AGF Investments. AMH, is she lying in this morning? Anne-Marie's going to come up, I believe, in about an hour from now to weigh in on some of this as well. TK, what was that? Cocaine in the White House over the last couple of days.
I haven't even...
I came back, landed in the United States, read some of these stories and was like, what, really?
I'm glad you brought this up. And for you to come back, seriously, folks, I mean, I'm busting John's chops, but, he needed the time off. He's British. All the British people, they take like 4 weeks off and, it's like holiday.
That's the continental Europeans.
It's like an Audrey Hepburn kind of Greg
They've
Peck
got the right idea. Let's be clear about
Rome
that.
for 4 weeks.
Sure, why not?
Okay.
Why not?
We got footage, too. We're gonna bring this up in a bit here. We have footage of Sojourn Ferro.
How did you get hold of that?
It's just, the Bramo cam.
All right. I look forward to that.
You should have seen the Bramo cam on Katie Greifeld.
How did that go?
She was a toxic brew.
Is Katie coming back anytime soon?
No,
she's still running.
Gone.
Jane Foley up next. Live from New York City. Welcome back stateside and a happy July 4th, the belated happy July 4th.
How are the airlines?
To those of you just taking a day off. I have to say, Tom, for me, no big delays, pretty smooth sailing.
Yeah.
International anyway. Domestically, I've heard all the stories in the United States.
I think it's like
a
two-part thing. We're trying to get Scott Kirby on, folks. We've made that effort and we'll continue to effort.
From United.
And Bastian at Delta, but Scott's in the news and he's been a good friend of the show. We'll get him on as we can. But I agree with the partition. Mrs. Keene's on the far side of the world. Same thing. Flight was effortless.
Just to be clear, he's in the news because he flew private when flights were getting cancelled. Is that right?
That's the scandal, but far more, it's this outrage of like a family like Bramo. Bramo tried to go somewhere. I don't know where Bramo is. I thought she was up at Tupper Lake in the Adirondacks, but she's stuck in an airport somewhere with 3 brats. I mean, it's painful.
She flies Delta.
Does
so
she?
Might
I didn't
be down
know that.
In Atlanta, yeah.
I didn't know that. She's stuck. I got an email from her. They're not even away. They're like in Terminal C somewhere.
Stuck.
Yeah.
Over the last couple of days.
Yeah,
fun.
It's painful.
We wish you the best, Bramo. Hopefully she's going to be coming back soon. Equities right now on the S&P 500. Futures a little bit softer. If you are just tuning in, overnight data out of China on the services side, not fantastic. We're down about 0.4% on the S&P 500. Let's see if that sticks. Coming into Wednesday, 3-day winning streak on the S&P 500. Year to date, you know the scores, but here they are again. Up around 40% on the Nasdaq 100 this year so far. Going into the second half with the S&P 500 up 16%. Big moves, not just big tech, and let's be clear about that. It's some of the more focused players on travel. You talked about the airlines, Tom. Let's talk about Carnival, Royal Caribbean, Norwegian, those names flying. The home builders on the S&P, those names flying.
Quickly, while you were gone, I did a banner of 24 months. SPX up 3%, Dow up 3%, NASDAQ up, I think, 6%, whatever. But we're looking at a 6-month track record instead of a 24-month track record, which is down we went and we just barely made it back. We haven't made record highs yet on a lot of this
What happened to the banking crisis? Look at the front end of the yield curve, 2s, 10s, 30s, and then we can compare a 2-year and a 10-year. 2-year, 10-year, that spread right now, negative, let's call it 105 basis points.
106, yeah, it was 110 while you were away.
The 2-year 489 came pretty close to 5%. Basically, going into the banking malaise, we were north of 5% on the 2-year yield.
Yeah.
Came all the way back down. And, Tom, we've come all the way back up. And we're talking about more rate hikes from the Federal Reserve.
I don't know which island. Ischia, I pronounced that wrong.
Can I tell you how stunning that island is?
Is it?
Ischia. And I'm really worried now after that New York Times article, which I'm sure that you read, that it's going to get spoiled.
Yeah, good morning to BNP Paribas Paris that informed me I was pronouncing Ischia wrong.
Ischia.
I didn't know that. Okay.
And then
you got to go to get the pronunciation.
And then you go to Procida,
right.
which is.
Did you have a TV on the boat in Ischia so you could see Sintra and the 4 central bank governors?
I didn't watch it.
Jane Foley watched every word of it.
I read Seth Carpenter's rap of.
What did he say? I missed that.
Seth was there and he made a really interesting point. It was about what they didn't discuss.
Yes.
Financial stability.
Yes.
That's almost unthinkable compared to where we were a couple of months ago. That you would go to Sintra, you have Bailey, Lagarde, Powell, all these central bankers there, and they wouldn't be talking about bank failures.
Jane Foley watched every second of Sintra. She reports now with Rabobank here on what the dollar will do. Off of the central bank confusion, Jane Foley, that we saw, what is your gross dollar call out 12 months?
Well, in terms of the pattern of the dollar, we had anticipated that it will sort of peak around about now. But as we go into the end of the year, that we could see some moderate softness because the market will be anticipating that the Fed would be cutting interest rates into 2024. But, a large part of where the dollar will actually lie depends very much on this debate, really, this friction between the resilience of the economy and the perceptions that we could be going into recession. I mean, the yield curve has been inverted now for a year. So the first half of the year, I think, was dominated by resilience. To what extent is the recession going to get the upper hand, or the recession scenario is going to get the upper hand in the second half of the year? Because if they do, that will chase money out of risky assets and support the dollar. So we don't see the dollar selling off heavily in the second half of the year, because if we do get recessionary conditions, that will support it as a safe haven, even though the market begins to anticipate that the Fed will be cutting rates in 2024.
Jane, the heritage of Rabobank is a great hedging institution, is flows of money. So like you take Germany flat on its back with a manufacturing slowdown, or all the challenges with China as Secretary Yellen visits. What do flows look like over the next 6 months? And how do they change a gross dollar call?
Well, I think in terms of actual trade flows, I think that's already pretty evident. In terms of manufacturing particularly, there's definitely slower there. We can see the German export numbers slower, and that, of course, is reflecting to some degree the slower growth in China. We can see this through a number of commodities too. We can see this through shipping prices, for instance. A lot of those supply-side constraints that drove inflation in the early parts of the pandemic and the latter parts of the pandemic even, have more or less been repaired. So there is evidence that flows have altered. But with respect to, the dollar remains, on 80% of, on one side of 80% of all trades, the dollar remains that dominant currency. So even though the flows may have slowed, the dollar is still very dominant. And in terms of fears of recession, that is something which will support the outlook for the dollar.
Let's do currency winners. Sterling. I went on the beautiful WCRS function on the Bloomberg terminal. Broke it down year to date.
You had a terminal on the boat?
Had a look yesterday evening when I got home.
Very cool.
Bloomberg Anywhere, beautiful thing. Sterling, the big winner of 2023 in G10. The dominant player. Now, Jane, when I look at yields in the UK, and let's break this down together, at the moment the 2-year is at about 5.29. Back in September, when everyone wanted to see Liz Truss out the door at number 10 Downing Street, we were pushing 470-something on a 2-year. Sterling was down at 103.50. Sterling right now is at something like 127. Jane, why have we got sterling strength now and tons of sterling weakness back then?
So, I think that raises a couple of really interesting points. The first thing is that when we first started to get sterling strength this year, it was around about March-ish, maybe late February, and that's when we began to see some better than expected economic data. Then we sort of quickly went into the spring and realised that the Bank of England's forecast of late last year of a five-quarter recession wasn't going to happen. That the economic growth was going to be better. So hence you get this repricing of sterling. Now that has continued into early June as the market priced in even more interest rate hikes from the Bank of England because of the stickiness of UK inflation. But I think there is a but. Even though UK fundamentals have improved significantly in terms of growth relative to where we thought they were at the end of last year, it's still not a great lineup. You've still got too much inflation. You've still got pretty weak growth. So you've got stagflation. You've got a high-debted government. You've still got a current account deficit, although it has shrunk. You've still got low productivity growth, low investment growth, all of these things, which ultimately mean that I think there's a point at which investors will say, look, OK, so we've now got long sterling positions, but we don't really want to extend them much more because the fundamentals just aren't good enough. And we've got to bear in mind that while sterling is the best performing currency, G10 currency in the year to date, it's still well below its long-term averages against both the dollar and the euro.
Jane, you said we get to that point where people feel maybe it's gone too far. Is 127 that point?
I think we may be at that point already. And if you look just, for instance, at the CFTC data, they jumped up, in the early part of June. At the last set of data, they jumped up a bit further, but not so much so. But these positions, speculators' positions in sterling, are at multi-year highs. And can we honestly answer the question that's justified given the UK fundamentals? That's really debatable. So I think we might already be at the point where sterling finds it pretty difficult to push much further.
I look, Jane, at where we are, and still on the hedging or on the broader macro, I still got to make money. Where's the opportunistic trade right now? We're going to make 3-4 big figures on a given pair.
I think what you've got to look at today is, for the next of the year, is probably some choppy ranges. I think a lot of people are still going to be looking at euro dollar, wondering if it's going to... I think this is the reality of what we got because, ultimately, if we look at the debates that are going on in terms of the outlook, it's really highly polarised. You've got people thinking, well, look, we've had all this resilience. Stock markets did well in the first half of the year. Maybe we'll have more on that. And on the other hand, you've got, what many economists say, no.
Yeah, I get that. But come on, give me a pair. It's Wednesday. Knocky stocky. Sing Aussie.
That'll get the ratings up. Knocky stocky.
Knocky stocky. It'll work.
I think we can wait till the end of the year, wait a little bit further, and then I think the Aussie will be, a pretty good play, but probably not yet. Australian fundamentals are better than most of their peers, but right now the market is so focused on the interest rate debate, and now it's like, well, they're going to pause. So nobody's going to go in and heavily buy a currency when the market is speculating that the central bank's going to pause. But I think later in the year, I think that some of those fundamentals will begin to shine through. I think the Aussie probably later in the year and into next year could be a good one. But right now, you know, I think the market's just trying to get its head around this polarized debate, and I think that just means pretty range trading, choppy range trading maybe, but I don't think we're going to have too much in terms of huge directional plays for the short term.
Jane, just finally, I know this is a big topic of debate over in the UK. It is actually in Australia as well. When do these housing markets blow up from interest rates this high?
Again, you know, if you'd asked many economists 6 months ago, they'd have probably said that should have already happened, and it hasn't. Again, we've proved to have a lot more resilience, there's a lot more demand. Certainly in some countries, the UK, there's a lot of technicalities behind that. For instance, a lot of landlords selling because of regulation, because they can't afford their mortgages, for instance, and you know, that's a factor too. There's demographics, which mean that there's generally a lot of demand. There's a lot of people living longer, there's a lot of people living in more single-person units than perhaps there would have been 20 years ago. This is all pushing into it. But right now, you know, I think we will have a slowdown in the property market in the UK, but perhaps not as drastic as many people would have anticipated, given the scale of the interest rate hikes that we've seen. Yeah, certainly not where we were expected to be a year or so ago.
Jane, thank you. Speculative call
Jane
Foley there. I don't think we did.
Not on the property market. This number, this data comes from UBS. Great write-up from the team over in the UK here at Bloomberg on what's happening with the UK property market at the moment. These stats, Tom, 1.4 million in the UK due to remortgage this year. Sounds like a lot, but it represents only a fifth of all households with a mortgage and 5% of the total number of households. So, Tom, they're the numbers for this year. Maybe the bite point, the pain point is further out.
Yeah, I'll go with further out, but what it is dramatically different than the United States. And to conflate the analysis, which I'm seeing way too much of, I think is I think it's really problematic.
Well, 30-year mortgages here in the United States, Tom.
You know, but it stays. There's nothing for sale.
For decades.
I mean, everywhere I look in geography, there's basically nothing for sale.
Which speaks to why home builders are up so much.
Yeah, I did see a couple units in the 60s and the 70s that think are. Yeah,
how much are they?
Well, they're near MS, so they're expensive. But you know,
have you been to that new store?
I've been to the new store. I got a tour. They called me up.
It looks beautiful.
Andrew gave me a tour.
It looks beautiful.
Andrew is keeper of the bow ties at Hermes. It's really something, and they're replicating it. The Dumas family's replicating it worldwide as well, sort of like what Louis Vuitton's doing with Tiffany's. You should do the Tiffany's store.
I haven't done that yet.
I heard a number, which I don't remember, on the amount of money they put into it, and it's outrageous. You know, Julian Schnabel paintings, and they got Audrey Hepburn stuff. And that. We got a video in here, folks. Finally, it's out of the photo lab. We wanted to give this to you 2-3 weeks ago when John was deep into his trip. But this is the Ferro. You know, this is a Riva Aqua Mara, I think it's called.
Aquarama.
Aquarama. Thank you. Have you been on one of these? What is it like,
wish.
John?
They're beautiful boats. You know who's been on one of these? Guy Johnson.
Really?
Guy Johnson actually did a
it looks
package,
like it's a Manus thing
with the company a number of years ago. TK, you use one of those boats really to go on, say, a lake or something like that, Lake Como?
Yeah,
George Clooney.
You were more on the. Well, this is like, you know, Sophia Loren.
When you're on the open seas, I don't think the Riva Aquarama gets it done quite as much. Plus, I want a bit of shadow. In fact, that might be. Have you got any video of Guy Johnson on a river?
I don't know.
I'm
we'll
sure
have to
we've
go
got
deep
some
into
in the archives. Yeah.
So seriously, these gorgeous boats at $500,000 each and up are
I'll tell you a story.
Lake boats, not ocean boats.
Let's finish with this story. So there I am, Conca de Marini, beautiful. Looking at these three yachts next to each other, TK. And I've always got a line about these boats. Doesn't matter how big you think you are, there's always someone with a bigger boat. Do you know who pulls up? Jerry Jones. He's seen the size of that thing? That boat, TK, is a monster. It's an absolute monster. You want to come with me next time?
I'm trying to get an Uber past, Lenox Hospital. Can I get an Uber, please? What do you mean, a 4-minute wait?
People sometimes ask, why then you had to do, as Saudi Arabia, the voluntary cut? And my answer is very simple. We had to do it because there was another ask for the market, a more immediate ask or a more immediate expectations of the market that the OPEC Plus would need to do so.
That was the Crown Prince Abdulaziz bin Salman, the Saudi energy minister, speaking at the OPEC seminar in Vienna. Live from New York City this morning. Good morning to you. Here's your equity market. S&P 500 futures on the S&P. Just a bit softer, negative here, as we kick off a shortened trading week for those of you that took Monday off and took yesterday off as well.
Yeah, those that took Monday off, yeah.
Some of us didn't, I know, TK.
Took June off.
Yields lower a couple of basis points. Just to be clear, I knew this would come up today.
Oh, you did?
So I went through the internal records. You have had 10 days off this year. I have had 10 days off this year, okay? 10-10.
Yeah, 10, but 10. you strategically
10, 10.
put them around vacations where
national holidays,
where it's like a British.
That's
thing.
strategic. That's what you should do. Why didn't you do the same thing?
I just had to go to teachers' conferences. You know, there's a difference.
You should do the same thing.
I got to take the day off. I got to go see what after.
Let me complete the market check outside of what's happening with equity
the
futures.
Today is just not the same.
In the bond market, yields coming back just a touch, going into payrolls on Friday. Still looking for a number in at around 200,000 to set us up potentially for the Fed to hike again in July. Remember, between the June meeting and the July meeting, only one CPI report, only one payrolls report. That payrolls report comes on Friday, Tom. That CPI report comes next week. Your 10-year at the moment about 384, 383.70.
If you get out a chart and look at oil, you will go back and notice a log rate of change called 1986. It was the fear. It is a skeleton in the closet for OPEC, OPEC Plus, OPEC Plus Plus, and also Manus Cranny. He joins us now on his latest junket to Vienna. We are jealous as well. Star of Bloomberg Television, Dubai. Manus, good morning. How much is 1986 haunting the discussion for the royal family of Saudi Arabia?
Well, they're haunted, Tom. By the way, 1986, brilliant year. I went to Queen's University. It was the start of a whole new world. More of that later. Yeah, they are haunted by that in there, Tom, because His Royal Highness Prince Abdulaziz bin Salman has a major political mission to deliver, which is a break-even on oil, which keeps his brother in an accelerated form of economic transformation, keeping destinations like Alula, the Red Sea, and Neom, those dreams, those economic dreams alive. And I think what's most prescient this morning about what he just said on the podium is that Russia, remember them, Tom? They're in the plus. Well, actually, they're the big plus. They're coming on board. They're squaring up, shouldering their burden. They're taking 500,000 of a drop in exports. That's what we need to measure, not the promised drop in production. And this is an interesting geopolitical ramp-up from 4 weeks ago when I was here. Oil's done nothing. $74 and change. But the political narrative has changed between Riyadh and Moscow.
Okay, it's changed between Riyadh and Moscow, but I want to understand around all of the politics, and frankly, folks, Manus is wicked expert on this. Is Riyadh driving the OPEC bus right now?
I'm nervous now. Yes. In a word, yes. But they've always been driving the OPEC bus, Tom. I mean, there's nothing new in that. I mean, they are the central bank of oil. And I think when the oil market looks at this and they go $74, oh, and the Russians are on board now, that's 3% of global supply off the table. There's a wonderful phrase I used this morning. You cannot put lipstick on a pig, Tom. We have a global manufacturing recession from China to Europe to the United Kingdom to the United States of America. You cannot dress that up.
Okay, the thing I really want to know, Manus, and this goes back to the brilliant work years ago of Adam Szyminski and Paul Sankey at Deutsche Bank. You got to keep track of where the supply is. For a guy like you, for Will Kennedy and Bloomberg Hydrocarbons, do we know what global supply is, or is it an unknown?
It's 80% known and 20% is your variable, but that's a high unknown known, if you know what I mean. And I'm talking about Iran at a 4-year high in terms of production. The Emiratis met with the Iranians at the Kapinski before they came over here. Mazrui, who's the UAE minister, basically saying we're not joining in on the voluntary cuts. So there's a lot of dark pools of oil around the world from various producers. You're bang on the money. Those are, you know Donald Rumsfeld, you probably interviewed him, but those are the known unknowns, which will always weigh on this market quite incredibly in terms of dark supply and dark fleets. Tom, John, is Lisa there? Has she got a day off? Take a lot of days off in surveillance.
The only
she's got
one,
a day off, yeah.
Manus, pro tip, Manus, the only one you can rely on to be here is me, because I'm the one with no life. Continue, John.
Manus, just a final question from me.
Don't start talking Italian. Just,
I'm not going to do that.
Okay, but he can do it with you. I can't.
Take us inside the meeting, Manus, because I have to say, from my perspective, the cartel is sounding more and more irritable. And when I hear about your coverage, Manus, and your ability to actually get in there, being curtailed over the last couple of months, Manus, can you tell us just what's going on?
Yeah. Look, this is a very empty press pool. Let me just stand aside for 1 second. Okay? There's me. I'm here. I'm standing outside. The Bloomberg print team are able to break news and read headlines despite that. People do talk to us on the way in and in the hallways and in the bars of Kapinski. The bottom line is they are worried. They are incredibly worried. Mazrui talked about the generosity of the Saudis in terms of the delivering 1 million barrels a day in terms of a cut. But the Emiratis are not getting on board with that at the moment. And the bottom line is, Mazrui and the UAE got an extra 200,000 barrels of a quota, Jonathan. I can't use off the back of other nations, but they saw a window to jump through and get extra quota for themselves, and they took it. There is a disquiet that we have not made better headroads from a near 3% drop in supply from where we were a month ago. But I am a lone ranger. I'm out here. It's 28 degrees. I will survive.
Manus Cranny, thank you, sir. Manus, we appreciate it. Over in Vienna for the OPEC
That
Plus
interview
meeting.
was longer than the meeting was last time.
I think so. How long was the meeting? Do you remember that one? It was like 12, 13 minutes.
It's like in and out.
I thought we were going to get Manus going on 1986 then.
Well, we talk about that in a moment. But seriously, folks, they have this paranoia, never forget 1986, where the price drop cratered, where they lost control. And that's something no one's looking for here, that OPEC actually loses control.
What do you make about certain journalists being locked out of the room? And to Manus's point, these organisations that have been pushed out of the room are still breaking news, doing a fantastic job. But what do you make of that?
Well, I think I'm not going to speak for John Micklethwaite, our editor-in-chief, but I think Mr. Micklethwaite and the rest of Bloomberg is all over this with other news organizations, just saying, look, this is the way we do this. It's an institutional meeting, and we need access.
It's kind of odd, right?
Oh, huge.
It's a bit strange.
They're trying to run the rule book as well. What I remember about 1986 and what Liverpool did to the Tots that year was terrible. It was 4-1. Ian Rush was awesome. But, that was
great
sort of
side
the beginning.
In the 80s.
That was
Fantastic
the beginning
side.
of the Liverpool magic.
That was the beginning of the dynasty of Silvio Berlusconi and AC Milan.
Yeah.
The mid-1980s.
Yeah. I had a Plymouth Barracuda used. You could see through the floor. You could watch the road go by. You could see through the floor. It was great.
Nice. Coming up shortly, David Leibovitz, global market strategist over at JP Morgan Asset Management. He's going to be with us around the table in about 6 minutes' time. Looking forward to that conversation. TK, tons to talk about with him. This start to the year, unexpected by so many people. And if you go back to December, where all the year-ahead outlook started to drop and people talked about a tough first half and maybe a better second half, and then the first half started, just phenomenal gains in the equity market.
Out of the pandemic, and this is central, out of the pandemic, there's no theoretical structure, and I didn't hear a coalesced monetary theory at Sintra. They're all flying, massively exposed, massively by the seat of their pants, and it makes Jackson Hole that much more interesting.
And the latest data suggesting they should do more. Jackson Hole, I agree with you, will be interesting.
Yeah, we'll talk about Jim Bianco here in the next hour. His call is stunning, which he gave us on Monday when you were away.
Whether Chairman Powell can actually set up a pause in late August. Tom,
I think we're beyond
I think people thought that was going to take place a couple of months ago, and that's not where we are now.
Yeah. When's Bramwell come back?
Next week, I think. Monday.
It's a British thing.
You're very sensitive about time off. Is it a British thing? Is it really just a British thing?
I think it is. No, it's
Isn't America
too.
slowly coming on board with this idea that time off is a good thing?
I said to them, I wanted 10 days off,
colleagues.
And they said, no, you got to lecture the interns. So I'm, giving speeches.
That's why you're here. Intern lectures.
It's the high point of the year. Talking
for them or for you? I can't imagine it being the high point for them.
The interns are like 80% of them have air conditioning. We're worried about the other 20%.
This is the longest hour of the last 30 days for me. Well, I think. We've got another 2.
Good.
This show works.
Have a what do you call them? The little pink drink, fizzy drink, Italian spritz.
A spritz or a Bellini?
Morning spritzes.
Which spritz? Okay.
feels like they're sort of locked in for this July hike.
If the inflation rate bottoms at 3 and starts drifting higher, the Fed's going to find this unacceptable.
Disinflation without a downside in growth, without an upside in unemployment, is the Goldilocks soft landing narrative.
We're expecting a soft landing, but that may be harder than others are thinking.
We might see a recession that might be mild.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Your equity market on the S&P 500, a little softer, negative on the S&P, going into payrolls on Friday. Some Fed minutes a little bit later on this afternoon. And TK, before we get there, we need to talk about the data out of China. Manufacturing worldwide, not great right now. We all know that. Services data out of China, Tom. Disappointing.
Another disappointing set out of China. And of course, the backdrop of this is the Secretary of Treasury will visit Beijing and talk about that economic slowdown and what it means for the Chinese-American dialogue. But far more importantly is this wicked holiday-shortened work week. And it starts today, Wednesday. And where we are in 72 hours, I have no clue. It's not just about a jobs analysis. A lot of economic data and how the market reacts.
Well, we can talk about where we've been. And Tom, a lot of people have been talking about that,
island?
I imagine, around the table with their family yesterday on July 4th. We can talk about my island tour a little bit later.
Thank you.
The gains year to date, TK. The amount of people that would have missed out on a 40% move in the Nasdaq 100, a 16% move on the S&P 500, a 40% plus move on home builders in America on the S&P. What's that about? What a run.
This is a huge deal, and we're going to address it in 2 minutes here with someone really qualified, David Leibowitz of J.P. Morgan. But, John, I agree the reset of June 30, make it July 4, is truly like it's never been in all the time I've been doing this.
And the reset in the bond market, again, banking crisis,
Who
bank
do you
failures.
fire today? Who do you call up and fire today if you're behind? I mean, that's what it comes down to.
Are you suggesting that's what people should do this morning?
No, I'm not suggesting that, but somebody at the 4th of July picnic is like on the phone Wednesday saying, we missed it. What do we do?
Missed it.
It's like a real conversation.
Told to go into cash because cash gives you something like 5%.
With Katie Greifeld, it was ridiculous. I had to do Bitcoin every 48 minutes and Doge.
What did she say about it?
I think she was just being responsible for me. I think she's,
well, that's
all
good.
crypto.
That's good to hear.
She's being all crypto, but this is not about making, quick thing in crypto. This is somebody whose retirement plan off the pandemic is actuarially behind by 150 basis points, and they just had the catch up, but they didn't participate because they didn't own
Andrew
tech.
Slimman of Morgan Stanley talked about this repeatedly over the last couple of months. He's been great on it.
Yeah.
You sit there at 5% in cash. It feels good. It feels good. It feels good. Then all of a sudden, it doesn't feel good anymore.
I totally agree.
And we're kind of at that point, right?
We're
going
at
into the
that
second
point.
half.
And the other thing I identified, John, which was a big topic while you were away, was we came off the October low, what I'm calling the Acampora-Yardeni low. How do you form a second leg of a bull market? I think that's the other thing.
Some people still calling this a bear market. Let's be clear about that too.
You can't go up without that.
Equity markets right now, futures, negative 0.4%. A bit softer worldwide as we start to get into the final straight of the week, going towards payrolls and the Fed minutes a little bit later. Most people expecting a July hike. What would it take to take that hike away from this Federal Reserve? Look to payrolls. Ellen Zentner and the team over at Morgan Stanley reckon something south of 100K on payrolls, something around 0.2% month on month in CPI. Might be enough to say to the Federal Reserve, don't do it. But for a lot of people, TK, they think that bar is pretty high, that this Federal Reserve is going to hike.
And someone like Ellen recalibrated, I'm going to say 6, 7, 8 days ago and went to a July lift here. I'd say most people are on the lift, but what's fabulous, and McKee mentioned this while you're away, the WIRP function's been adjusted with a beautiful chart that shows we're still modeling rate cuts. Really?
2-year right now, 490. With us around a table, David Leibowitz, global market strategist at J.P. Morgan Asset Management. David, wonderful to catch up with you, sir, post July 4th, and I hope you had a wonderful holiday. Let's start there. You missed it. What do you do now?
So I think what's interesting is that we all missed it. People came into this year with a view that, okay, maybe you get a little bit of a bounce because 2022 was so bad. but certainly not 15% on the S&P in the first half of the year. And so I think what you do is you actually don't do all that much, because what we don't want people to do is to begin chasing this rally. We do see some storm clouds on the horizon. We do think that the risk of recession has risen. I do think that the Fed is going to continue hiking rates. Yes, we've had a very good run in risk assets, but I wouldn't chase this rally too much. I would stick to your plan, stick to your asset allocation, rather than moving things around one way or the other.
I'll get that, but you have to identify a second leg of a bull market. Is J.P. Morgan allowed, with all your economic work, Casman Ferroli, to say we have the underpinning of what can be a legitimate broadening out bull market?
So I guess there are two things that give me pause about that possibility of broadening out from a bull market perspective. The first is that the entirety, effectively, of the rally that we've seen year to date has been driven by multiple expansion. Right? So earnings growth hasn't really participated. And so what we need to see in order to remain constructive on risk assets here is evidence that, the potential downside on earnings is potentially not as bad as what a lot of people would expect. If we do hit a slower patch in the economy, potentially a recession, I think you're looking at earnings estimates which are signaling that profits will continue to rise. And to me, that's a tough pill to swallow.
In the real world of sitting around, when we celebrate that the colonies won, and we're sitting around and we're having mustard, not ketchup, on our hot dogs, and there's one guy there livid at a given institution, let's pick on J.P. Morgan, and saying, okay, what's the plan to catch up? What's the J.P. Morgan plan to catch up if I was above average, but nothing like what NVIDIA did?
So I think the best thing that people can do today is try to preserve their optionality. And we would encourage two ways of doing that. First would be by not forgetting about fixed income, right? We talked about how sitting in cash feels comfortable, and obviously you're getting paid from the bond market once again. We still think that optionality, maintaining a relatively short duration, could work in your favor, because if you get a big pullback in equities, you're going to be able to deploy that capital and try to catch up to your question. The other thing is we would maintain that shorter duration on the equity side as well, focus on the dividend payers, focus on the high cash flow companies. Again, there's a lot of excitement and a lot of enthusiasm about things like artificial intelligence, and I do think that it'll boost productivity over the longer term, but I'm not sure it's going to boost productivity tomorrow, and I'm not sure it means that we're going to avoid some sort of soft patch in the economy over the course of the next 12 months. So this all feels very sentiment driven. That's why we're so focused on profits and the optionality that those cash flows can provide.
NVIDIA's making money, Meta's making money. Where does tech fit into that? Just to build on that a little bit more.
No, and we talked about this a couple of months ago. What was really interesting about watching tech into the end of 2022 and the beginning of this year is that they've been taking their medicine, right? They've been laying people off. They've been defending that margin. They don't necessarily have the type of pricing power that you're seeing from, say, the airlines in the current environment. And so you're actually seeing tech margins hang in there. And I think that does limit the downside to the market if we do hit a slow patch or a recession in the economy. But my general take is that even if inflation is still above the Fed's target and real growth is slowing, tough to see how earnings in aggregate continue to expand.
Just going through the top 10 on the S&P 500 year to date, NVIDIA, we all know that name, Meta. Then you've got these cruise operators, Carnival up by 135%, Royal Caribbean up 109% year to date, Norwegian up 79%. There's a home builder in there, up by close to 70%. What's all that about?
So I think that this is the big question, and I think this is part of why so many people have gotten the market wrong this year. It feels like we're seeing these rolling recessions in the economy, where first it was the cyclical parts, the rate-sensitive parts like housing. Obviously, you had services shut down during the pandemic, and things have continued to bounce there quite nicely. The path to a soft landing here is that everything fails to roll over at the same time, and we just see these little kind of mini explosions and mini soft patches, which isn't completely unfeasible, but I think what you're seeing in terms of the top performers outside of the tech names, services. People are still out there spending money. They're still going on vacation. I was in Orlando the other week. The airport was full. You look at home builders, right? When it comes to mortgage rates, it's the big move that puts things on ice. Now people look at the numbers and they say, well, the house is more expensive, rates are more expensive, but I don't think that they're necessarily going to continue to rise. And so you're beginning to see that stabilization in those parts of the economy. And I think that that's why people continue to gravitate to the soft landing thesis, although it seems like a bit of a stretch for us.
Where do bonds fit in?
So I think that bonds, for us, the shorter end of the curve continues to look most attractive. You're not getting paid to go all the way out. I think selectively adding duration when you get a 10-year that edges up towards 4% makes a lot of sense, because over 12 months, right, if rates end up falling, that's going to work in your favor.
The zeitgeist this weekend, John, while you were away, was simple. People are stunned at how retail, and particularly older retail, is all in stocks. The lessons we learned, CFA kind of chit-chat, it's been thrown out the window by a public just buying and buying and buying stocks.
So let's talk about something that's going to come up a lot. You'll hear people on programs like this talking about triple-digit inversion, 2-year, 10-year, negative 105 basis points. For a lot of people listening, and they've heard this a million times, the curve's inverted. That's dangerous. That's bad, isn't it? What does that mean, negative 105?
So that's close to as inverted as the curve has
early
ever
80s,
been,
right?
We have to go all the way back to the 80s. And, again, you think about history, and it doesn't always repeat itself, but it does tend to rhyme. And I think what the yield curve is telling us is something that, a lot of people, I think, know in the back of their minds, but hesitate to really wrap their arms about, is that squeezing the last little bit of water out of this inflation sponge is probably going to be more difficult than a lot of people expect, and it's arguably going to require a recession. And I think that that's what the yield curve is saying. It said the Fed has recognized that if they want to prioritize controlling prices, they're going to need to potentially crash the plane. And I think that that's why you're seeing the curve as inverted as it is
Just
today.
to finish on that then, David, does that imply this Fed has to sit at 550 for a longer time than people expect? Or does that imply that this Fed needs to go higher than 550 and maybe even closer to 6%?
So I think that the risk to rates is still to the upside. Obviously, my boss's boss thinks that 6% is potentially in play. It wouldn't surprise me, but I think at a minimum, what investors need to be prepared for is the Fed going to somewhere around 550 and then not blinking until the labor market deteriorates in a way that they can no longer ignore it, right? 3.7% on unemployment is not going to catch the Fed's attention. 4.5 will.
David, it's a slow news day. Can you state that Mr. Diamond's looking for a 6% level in Fed funds rate?
He came out and said that.
He came out and said that.
He said he thought we were going to 6.
That's not, that's not news. You're trying to get him in trouble.
I don't know. David writes his annual letter. It's like a 58-page letter.
David's writing that for Jamie.
They call up Leibowitz and they go, come on, write this thing for us.
David, would you like a final word on that?
Well, I think what's interesting is that it wasn't too long ago that people were highly skeptical that we were going to 5.
Right.
And this is a Fed that has taken the inflation problem personally. They've already made one policy error. Right? They started too late. I don't think that they're going to make another by quitting too early. How many days a week are you in the office? We're in the office 5 days a week.
5 days a week. Are you going to get a view of Park Avenue in down at the end of Park there, Pan Am Building, or are you going to be looking out over New Jersey in the Hudson River? How do we fit that in right now?
I think time will tell. I heard it's how good I am at calling the Fed is going to determine where my new seat is.
6% Fed. Leavitt's got a star office view.
David, thank you. It's good to see you.
See you guys.
Thank you very much. David Leavitt's there of JP Morgan Asset Management. If you are just tuning in, welcome to the program. The S&P 500 this morning, negative by 0.5%. Coming up at about 8:30 Eastern Time, so about an hour and 15 minutes from now, Ed Hyman of Evercore. What a wonderful conversation. TK, there's certain people that you sit alongside that I really look forward to hearing. This guy and you coming up in about an hour and 15 minutes. Ed Hyman, Tom Keene in conversation. Coming up shortly.
We're going to talk with Mr. Hyman about his call for recession and particularly his call for disinflation. Jim Bianco on Monday pushed against that big time. Ed is looking for a slowdown and the stickiness will drift away. Bianco is saying down we go to a certain level, and then the shock of 23 and into 24 is a stickiness where inflation rates may actually bounce back higher.
Just to build on something that David told us just a moment ago, it reminds me of what Sarah House of Wells Fargo said several months ago. The last mile of that inflation fight
is brutal.
It's going to be tough.
Yeah,
it's going to be hard.
And the reset here academically, and this wasn't addressed at Sintra to my chagrin, but the reset here of this academic debate over where the new 1.8% is, say, off of a 2% model is huge. John, I'm learning new things every day. I had no idea. Thank God you told me on the break that you don't put Prosecco in an Aperol spritz anymore. You lose the Prosecco and you use something called Petnat, which is just a fancy sparkling wine of Ischia or whatever it is. So you lose the, you don't do it.
This is what you've been learning in the
ugly Americans.
Ugly Americans
drink Aperol spritzes. That's what
I love a Bellini, TK.
Bellini.
I love a Bellini. That peach puree.
It's a great movie.
Nice.
I think she has a lot of energy. And Tom, let me go out on a limb and make a fearless forecast. This will be a fairly successful summit. I mean, they're not going to cut explicit deals on semiconductors. That would be way too optimistic. But I think they have a very good dialogue. They set the table for further talks this fall.
Janet Yellen, the Treasury Secretary, taking off and heading to Beijing a little bit later on today. That was Greg Valliere, the Chief US Policy Strategist at AGF Investments, on that trip to China following comments from Xi Jinping, the leader of the Chinese Communist Party, calling on nations to reject decoupling and, quote, severing supply chains. TK, this coming after moves from China to curtail the export of two key metals. On top of that, the Wall Street Journal, the Dow Jones publication, Tom, reporting that maybe we restrict access to cloud computing as well stateside too.
Yeah, I saw the cloud.
A lot of back and forth, just tension simmering as Janet Yellen makes her way over there.
Simmering is the right word, but to me the backdrop here, and this is still in the zeitgeist, which surprises me. Long ago and far away, John, we were at the IMF, and the bombshell there was a 5-year 2028 view of, I'm going to call it global lethargy, to get away from the hysteria of it. And the backdrop to me of this for China is if you model out subpar GDP, what do they do with all those people? You know, I don't see it.
Services data not great overnight. Manufacturing hasn't been great for a while. All this talk about stimulus coming out of China. A lot of people are focused on the same thing, Tom.
In social media, you see a lot of the young kids graduating and they're doing some lethargy thing. It's like
What's that?
It's a TikTok thing.
What is it?
I don't know. They're protesting that they don't have jobs or something.
Oh, right, because youth unemployment's so high.
And there's a history. There's a shot. It's not on TikTok because TikTok wasn't invented, but it may have been early Twitter where it's Anne-Marie Horton sleeping on a park bench because she's protesting because she can't get a job.
That was AMH protesting back in the day.
She's protesting back.
She'd sleep on a park bench. What kind of protest is that?
It's a protest that the economy sucks, so I can't get a job, and that's how a lot of Chinese feel.
Okay.
Big time. Joining us now, Bloomberg protest correspondent, surviving the 4th of July. Thought I saw her sitting behind Reds Nationals baseball as they played the American sport in Washington. Anne-Marie Horton joins us right now and this morning. Anne-Marie, I'm absolutely fascinated. If we had a Republican president and the Secretary of Treasury of a Republican president was traveling to Beijing, how would it be different than Secretary Yellen as a Democratic Secretary of Treasury?
I don't think there's a tremendous amount of daylight between the Democrats and Republicans at this moment when it comes to policies on China. Remember, the Biden administration kept in place the Trump-era tariffs on Chinese consumer goods, and then they've just ramped it up since then, whether or not it's export controls or more penalties. They're looking at what Jenny Leonard and I are reporting. By the end of this month, potentially, that's when you're going to get that executive order on outbound investment. The Wall Street Journal is looking at the semiconductors that are needed in the AI industry space, as well as potentially companies like Microsoft or Amazon having to go to the government before they can have contracts when it comes to cloud computing in China. So you're just going to see a lot more of this, whether or not it's a Republican or a Democrat.
Right.
When you have the Treasury Secretary going over, this is just really setting more of these guardrails about how they are going to conduct business. And Greg Valliere said to you guys earlier, he thinks it's actually going to be a productive conversation with Janet Yellen heading over to Beijing today.
Yeah, I look, Anne-Marie, at the foundational theories we have of the relationship across the Pacific, and I'm going to go to the great Catherine Mann, now at the Bank of England. She codified our dysfunction and our codependency. Forget about the Tom Keene world and the John Ferro world. Your world of politics. What is the political codependency that we have with Beijing?
Well, it's that, and we're going to see it on full display as we go into 2024. It's that China is a very easy target to hit politically from the right and the left, which is why many would argue you saw the Biden administration keep the Trump-era tariffs on consumer products even when inflation was incredibly high. They kept those tariffs on because China, politically, you need to continuously be seen not just talking tough, but taking tough actions on. It's also why in the House of Representatives, not just the policy work they want to do, but the messaging and the socializing they want to do. They have a China Select Committee. So this is only going to get, in terms of the rhetoric, more heated as we head towards November of 2024.
MH, of course, less interested in the rhetoric and much more interested in the action. So let's talk about that a little bit more. You mentioned it just a little bit. China's decision to control the export of two key metals. How is the White House responded to that. There was a suggestion in the Wall Street Journal in the last 24 hours that perhaps that you'd get some kind of restrictions around cloud computing. What are you hearing?
Well, I'm not sure if it's going to be an exact tit for tat for these two critical metals, but obviously the White House, they are going to be tracking this. And what China is doing, which sounds similar to some of the reasoning the United States talked about, is saying this is off of national security concerns. But we should really talk about how key these two critical metals are, germanium and gallium. They are used in energy sector, the defense sector, think night vision goggle material, think fiber optic cables, a number of critical uses for these metals. And China has the outsourcing of this, not just the raw materials, but the processing of it. And it is just incredible how much they dominate this market. For one of these metals, it's almost 95%. And the U.S., for most of these, is a net importer. So this could potentially be a problem. I would say when we saw this happen in 2010, when China started to potentially tighten up some of its exports of metals, what the U.S. did and other countries did is they want to take it to the WTO. And what they started to do was strategically make sure they were starting to build their own supply chains for metals. So what you're going to see the U.S. want to do is go to places like Canada, go to places like Africa, make sure that inside the United States they're setting up these processing plants. But I'm not sure at the moment we're going to see a tit for tat for this, or at least they're not going to socialize it as it is a tit for tat for this. But the ramping up on the U.S. wanting to make sure they're conducting their business with China, that is going to continue.
Xi Jinping is calling on nations to reject decoupling. The Europeans are saying we don't want to decouple, we want to de-risk. A question I asked last hour, Anne-Marie, I'd love your view on this. What does that mean? What's the distinction between decoupling and de-risking?
It's a great question. We ask a lot of U.S. officials this, if they can explain it. I think for the U.S. and Europeans, decouple seems more severe. We are going to completely sever ties in certain industries with China. De-risking has this idea, and how they explain it is that we are just looking to continue some business with China. I mean, we also need to look at the data here. There's massive amounts of business between the United States and China, Europe, especially Germany and China. But we are also at the same time going to make sure we are fortifying supply chains outside of China around the world and make sure that those supply chains and those business ties are strengthening. Look at what's happening with India. The U.S. just had a state dinner for Modi. That's where the G20 is going to be held. This is going to be a critical player in terms of fortifying supply chains outside of China. And that is what you see businesses and countries continue to do.
G7 or G20 next year in Italy? Which one is it, Anne-Marie? Just want to secure that date.
G20,
Let's get that date set.
G20 will be in India in September. G7 will be in Italy. The Italians are hosting the G7. In Puglia will be the Leaders Summit.
Are
but remember,
you
around the
kidding
G7,
me? Give me a date.
I'm not sure it's the exact dates off the top of my head, but not just Puglia for the Leaders Summit. Remembers.
No.
It's not far. What you would need to do is take the train from Bari to Naples and then a ferry from Naples to Ischia.
I'm trying to get the train to Lexington at 59th, and she's like, Bari?
You've got the Adriatic coast, Puglia. Then you've got Campania on the other side, which is where Napoli is. And then you get the boat over, as AMH suggested. Anne-Marie, thank you. We're going to go to that, I think. Next year, Puglia, the Leaders Summit.
Requirement. Can we go on one of those wooden boats?
Got to make that happen. You want to go on a Reaver boat?
Yeah.
Okay.
I've never been on.
We'll try and fix that up. We'll try and fix that up.
Wear my Speedo.
I'll take you back to the childhood roots, Tom, in the south of Italy. Would you like that? Go on a little tour.
I like that. Seriously.
Yeah, it'd be nice.
It'd be great.
The romance of it all. Future's negative. This is Bloomberg. Georgia Maloney writes in, mid-June 2024. Tom, G7 in Puglia.
I can make that happen.
Next year. I think we can all make that happen, can't we? What a beautiful location for that to take place.
Well, it is.
12 months from now.
You wonder, seriously, where Southern Europe will be. You've got the success of Greece and all with Francine Lacroix's conversation with the Prime Minister.
Great conversation.
Of Greece and Italy in turmoil is how I'll put it politically after the death of Berlusconi and all. You wonder where will they be a year
France
from now?
in turmoil.
Yeah. I mean, and where will the whole set of European continent people be in a year? I don't know. We've got a major issue. We have to stop the show on equities, bonds, currencies.
What's that?
Commodities. And I didn't know this, besides I'm mispronouncing it. Stop mentioning Ischia.
Ischia.
Ischia. It's like an island, and it's like, what's it like, Martha's Vineyard?
No, it's beautiful. Not that Martha's Vineyard isn't, but it's absolutely beautiful. It is less busy than I would say Capri. It's bigger too. It's really, really big, Ischia. You'd be surprised.
Oh,
Tom.
really? It's like a big island.
It's a big island. It's a big island. It has Project nearby,
What
which
do
is a
you
beautiful
wake up
island as
and
well.
what do you go have fish?
You go have fish in the afternoon.
Yeah.
Yeah, that's not my breakfast
Is
of
there, like,
choice in the morning.
beaches, or-
There is a beach. There are some beaches. We stop mentioning it, Tom, because we don't want it to get busy. We
Okay.
like that it's quiet.
Okay.
That there's more romance there than maybe the champagne popping of Capri and all the money and all the glitz and all the
Spritzes.
glamour
They don't
and all the
serve
boats.
spritzes on.
They serve spritzes.
Ischia or whatever
yeah.
it is.
Okay, we should probably move on. I'm sure our producers are very frustrated with this
They
conversation.
shouldn't.
and where
They
it's
shouldn't
going.
be. It's a magical moment. We're just it's like
Let's go
you know,
to stocks.
it's
There we
like
go.
when
Beautiful.
when
Perfect timing.
You know,
Let's go through some boards, TK.
reacquainting ourselves.
The S&P, I missed you. I really did. We're down about 0.5% on the S&P 500. Bit softer. 3-day winning streak on the S&P coming into Wednesday. On the Nasdaq, we're down about 0.6% as well. Some underperformance on the Russell, the small caps, down by 0.75%. You know where the performance has been, though, year to date. Just the wow performance of the Nasdaq 100. Just monster moves, up something like 39% year to date. On the S&P, up 16%. The 2-year, almost reclaiming 5%. And not really making a dent in the equity market. 491 on a 2-year this morning. Yields come back a couple of basis points. The curve steepens just a little bit. But, Tom, look at this curve. 2-year, 10-year, negative 104.
Yeah.
Call it negative 105
And-
basis points. Unreal.
And I just noticed this off the launch pad where we look at equities, bonds, currencies, commodities. Quietly, the Bloomberg Financial Conditions Index has moved out ever more accommodative. That's not what Chairman Powell wants.
And he's leaning into the idea that the majority of the committee want to hike again. 2 more stops for that debate. The payrolls report on Friday and CPI next week. Just to check in on the FX market, just briefly, the euro against the dollar, just south of 109 this morning, unchanged at 108.79 TK in the FX market. Just a bit of a churn. No big moves here on the euro against the dollar.
Today, in your equity belief, we're going to bring it over to the fixed income space. Tom Sosaris Jones is now head of fixed income research at Strategas. It is a Baird company. You have the huge advantage, Tom, of working with one Jay Trennert, who does beautiful quality stock, free cash flow, persistency of profit analysis. Did it with Ed Hyman, who will join us here later. You guys own the high ground on the linkage of equity analysis into your bond analysis. What does your bond analysis say about a second leg of a bull market?
Highly unlikely. And with that said, we recognize that the equity market seems to disagree with that hypothesis. But when we look at that inverted yield curve, what we see is a market, an economy, which is already facing excessive tightening from the Federal Reserve. That is, the Federal Reserve has already tightened to the point where Main Street is feeling the pinch. But when you see, as you mentioned earlier, financial conditions easing, what you also see is a financial market where the Fed has not tightened enough on Wall Street. So one of the ways we phrase this is when you use the Fed funds rate to tighten, you put most of the pain on Main Street. When you use the balance sheet to tighten, you put most of the pain on Wall Street. The Fed has not tightened enough on Wall Street by using the balance sheet to reduce liquidity in the financial system. They've already tightened excessively on Main Street. So a recession still seems inevitable to us in the second half of the year, and that has got to impact earnings on the equity side.
Is a thermometer, I'm going to look at the inflation-adjusted 10-year yield. There's other metrics as well that a sophisticate like Sosaris uses, but I'm going to look at the 10-year real yield at 1.58%. Maybe it was 1.62, getting a little lofty. Do you anticipate that that will break out to a higher real yield? And what level is normal of a higher real yield?
Well, a normal might be, and keep in mind, we only have about 25 years of actual data on real yields.
Yeah, it's like yesterday.
Back to the TIPS market of 97, 98. Normal might be 150 basis points. So we're roughly at what you might expect to be a normal real yield on 10-year treasuries.
Interesting.
Now, with that said, we do not necessarily expect 10-year real yields to rise much from here because we expect inflation expectations, or inflation itself is getting close to bottoming this cycle. We think it's going to be very difficult for the Fed to get inflation below 3%, and we've already got expectations below 3%.
And the headline there, John, is on the edge of Bianco. I mean, this is the second time in 48 hours I've heard this.
That phrase there, I almost thought you misspoke. You think inflation expectations are bottoming for this cycle?
Yes. And that's because we buy into the hypothesis that inflation is going to remain sticky and that the Fed does not have the stomach to do what it takes to permanently bring this structural inflation back to a neutral. By that, we mean do excessive damage to the labor market, bring aggregate demand well below potential. That's what's required, and that's a pretty deep recession. We don't think the Fed has the appetite to do that.
You don't buy into the Volcker-esque delivery of Chairman Powell in late August last year?
No, I don't. If they were serious about bringing inflation in line with long-run targets, they would have reduced the balance sheet at probably 3 times the pace they're going at.
So just to be clear, on the balance sheet call, you think they should be more aggressive with QT? You don't think they will be?
Oh, absolutely. Exactly. Both to the yes to both of those. We think they should have been more aggressive, but we think they will not be.
I'm fascinated by this. Jim Bianco out in Chicago, and you guys have a call of a disinflation. We're going to disinflate, come down, and then at 3%, what do? Reverse and go up how much? What's that model show?
Well, right now we're expecting a bottom around 3%. We'll call it year-over-year headline CPI. On a quarter-over-quarter basis, we might see inflation dip below 3% fairly easily. But you start to see around 3%, the Fed gets weak knees. You start to see that the labor market is getting to a point where to bring inflation down much lower, you got to do a substantial amounts of damage because all of a sudden businesses are no longer hoarding staff. They're laying off staff they do need, and that's demand destruction. And that's a bigger recession ahead of 2024 that the Fed probably doesn't want.
But again, to bring it over to Jason Trenner's work, if I have a sustained 3%, which is your minimum call, maybe actually higher, that gives me a nominal GDP that's extraordinary. Does that support well-run companies in America?
Well, that supports companies that have low borrowing costs. That supports companies that have bargaining power or pricing power in their industry and strong management and have basically barriers to entry as well. It doesn't support companies.
That describes John Ford stocks out of 500.
And we'll look at the Russell 2000. 45% of the companies in the Russell 2000 don't fit that. They're the exact opposite.
These are big calls. If you're expecting inflation expectations to bottom out, where does that leave fixed income? For people sitting in the 10-year right now, taking on a bit more duration, what are you telling them?
Well, right now, let's say 10-year Treasury at 385. That actually looks attractive to us in a environment where the U.S. economy goes into recession, real yields come down, inflation expectations really don't move much. They might even go up. You still have downside in 10-year Treasury yield up down to maybe a 3% to 3.25%. But let's put that in perspective. The average recession sees a 10-year Treasury drop 225 to 250 basis points. That's probably not going to happen this cycle. At most, we're looking at that 10-year going from 430, where it peaked last year, maybe down to a 320 to 3%.
This is really important stuff. What we're discussing here is ultimately how the bond market's going to behave in what you've described, and I'll put a name on it, in a stagflationary world.
Yep.
Is that correct?
Yes, exactly. And now, again, we're looking at positive total return in a 10-year Treasury. We'll call it a 7% total return upside when yields drop. And if you're levered 3 times like many funds are, that's a 20% return that offsets maybe a 25 to 30% loss on the equity side. But the thing is, you're not looking at a 50% return in treasuries. You're looking at a 6%, 7% levered up to 20%.
Amazing, Tom. Just amazing.
I really can't say enough. You know, we're making jokes about it, folks. We're into the summer. We're getting lazy and sloppy like everybody else. It's an incredibly holiday-shortened week. We're compressing 3 days, John, of serious economic analysis. And I got 2 competent shops, Bianco and Strategas, saying the same thing, that we're going to I'm making this word up. Disinflate.
Well,
that's all brand new.
That phrase, just this idea that inflation expectations are bottoming out for the cycle. That is not what this Federal Reserve, Tom, wants to hear.
At all.
No, at all. No. So 25 in July is what most people anticipate. Some people saying maybe another 25. The committee suggesting that might be the direction of travel. Yep. And then you think they're done as well?
I think so. And let's keep this in mind. The higher they go with the Fed funds rate, the more likely they are to reach their target of 2% inflation. But we just don't think that they have the stomach to keep doing this. There's going to be demand destruction. And you got to also look at the second half of the year. The two stories in the second half of the year, obviously recession risk is one of them. The other one is you're looking at massive liquidity drain from the Treasury raising cash and adding back to its Treasury general account. And you're looking at the Fed continuing to reduce its balance sheet, albeit at a very slow pace. So if the Fed were to go to, let's say, a 6% Fed funds rate, of course, the chances of them bringing inflation down are much higher. But I don't see them doing that because there's already liquidity drag or liquidity drain coming in the second half.
Well, you're calling recession anyway.
Yep.
And a recession that comes without rate cuts?
For now, yes, because I do think where the Fed will be sticky, and keep in mind, I don't think the Fed is going to go to 6% Fed funds rate, but I do think they're going to hold the funds rate at whatever they terminate, 5.25%, 5.5%, whatever it is. They're going to hold it there for as long as possible, and then they're going to cut. So that means now we're looking at those first cuts probably coming in February of next year.
The world you describe, so stagflation, a Fed that's not willing to crush inflation, ultimately might start cutting next year, sounds pretty dreadful for risk assets, doesn't it? Recession as well, all these calls that you've got.
It absolutely does. And I think the silver lining here is that eventually they do cut. And because you're looking at an economy that is still relatively balanced for the most part at this point, you're not looking at extreme excesses in housing, in energy investment. Your recession is shallow, and there should be more of a V-shaped bounce off of it once we reach that trough.
Well, how'd you get the V if it's shallow? Just to build on that, just finally.
Because you do get a Fed that does eventually cut aggressively in 2024 or 2025.
And this is one of those conversations that later on today I'm going to replay and listen back to. This was great. Tom Tesouras there, a strategist. Tom, with some, I would say, some big calls on several fronts there, on monetary policy, on the economic backdrop, all of the above.
I mean, this is something new for the end of June and into July. This disinflation is a huge deal if that's an outcome. No one's modeling that in. I mean, I don't want to say no one, but next to no one.
Very few.
Sure.
Tom, good to see you. Thanks for this. From New York, if you are just tuning in to the programme, welcome to the programme. The S&P 500 right now, equity futures, negative 0.44%. Coming up in about, let's call it 48 minutes' time, sitting down with Ed Hyman of Evercore ISI, Tom Keene, to build on this debate, Tom. Great
Huge
guest.
debate, yeah.
Great guest to weigh in on this.
Well, it's going to be great to see because Ed Hyman's going to give us a talk about disinflation and the idea of what the Fed will do here. And I think it dovetails into nicely what Tom said as well. So we're going to have a lengthy conversation with Ed Hyman. I believe Michael McKee will join as well. We're going to really, grill him on where we are because he's done so well with the tendency here. And, of course, the inbred Hyman optimism on America. John, I'm doing the response. Thank you so much for the response, folks, by Twitter and email.
What to?
To the Italian islands of Jennifer. Did you visit the castle in Ischia?
In Ischia?
They have a castle?
They do have a castle, yeah. I
didn't
visit.
They filmed Cleopatra there.
I went past on the boat.
When I was a kid, Cleopatra was this huge movie. I wasn't allowed to see it, and it was Liz Taylor and Richard Burton.
Lots of
That's
movies
where they filmed
made.
it.
Lots of movies. Have you ever watched Il Postino? Great movie.
Maybe.
From a long time ago.
I don't know.
That's on the island nearby.
You should
go, Tom. You should take a visit.
And they also, of course, talk about how it folds into your jet-setting life. And it's Ischia and the talented Mr. Ferro.
You're very bitter about not taking vacation. You should.
It's very good.
You should dabble, Tom. You should dabble in a bit of vacation taking.
How do you get to Ischia?
Ischia.
How do you get there?
You get a boat, Tom.
But you fly to where?
Into Napoli. Into Naples.
Naples, we call it.
And then you can get a ferry from there.
Tots wants somebody from Napoli. I don't know who it is.
Who do they want?
I can't pronounce it. I don't know.
Well, it's good to see that you're up to speed on some of the transfer dealings of your football club.
He wants this guy in Napoli, except it's Naples.
That's the latest information on Tottenham. That they
Arsenal,
want someone, but you don't know who it is.
September 23.
Okay, we'll try and make that. All right, we'll go.
Billions of people depend on our commodity, oil, for daily life. This is an inescapable reality that warrants respect. That is why OPEC pursues market stability. Of course, as an industry, we want to ensure that we have an emissions-free future.
I'd love to know what that means, and hopefully he can explain that one day. The OPEC Secretary General speaking at the OPEC seminar in Vienna. Can you make sense of that, Tom?
No,
as an industry, we want to ensure that we have an emissions-free
it's a cartel
future. Aren't they in the oil business? Aren't they? Not that I have a problem with the oil business, that's not for me to make any suggestion that I would have a problem with the oil business, but to come out and say those things, and what does that mean? That we want an emissions-free future? So they don't want us to use oil anymore. Is that what they're saying?
We can pause here. We got lots to talk about, but I must admit, in the first half of the year, did we see a climate change debate adjustment, amendment, or persistence, I should say, on ESG and the rest of it as well?
Yes.
I don't think we really
From
saw it
financial
coming.
institutions as well.
Yeah.
The politics getting really interesting. These are things we can talk about.
Yeah.
Saudi oil, as you know, in focus at the OPEC seminar. It's their football league making headlines at the moment too, signing the likes of Karim Benzema, Cristiano Ronaldo, all in the last 12 months or so. Bloomberg's David Hellier writing the following. The Saudi Pro League is discussing the option of new broadcast deals, partnerships with private equity companies to grow the competition's appeal as the kingdom, Tom, works to become a powerhouse in the world of professional sport. This all according to people familiar with the strategy. TK, it's not just football, it's golf as well. That's been in the news over the last few weeks. It's a lot of things. It's a lot of things.
The flashing of money as well. What we're going to do, this is really a special treat here. I was hugely influenced years ago in reading, I'll say, 5 books on the Kingdom of Saudi Arabia and all the romance back to 75mm Lawrence of Arabia a million years ago of this experiment that is the Saudi family. Ellen Wald is definitive on this. We usually talk to her about the major revenue maker, which is oil, maybe Aramco at Formula One. But today we digress. And with Ellen Wald, we speak of this royal family and what they're doing to global sports. Ellen, are you surprised that the Saudis want to acquire entertainment prestige?
No, I'm not. I think that this really goes along very well with their kind of general search for global prestige, especially in terms of the West. And, they're not really getting it from oil anymore. Yes, they still are providing this incredibly vital resource, as you just mentioned, to the world. But it doesn't necessarily come with prestige. In fact, it comes with a bit of the opposite, given how prominent the climate issues are today and how prominent they are in discussion. You even saw the OPEC Secretary General making reference to the fact that, of course, we want an emissions-free future. Well, really? Aren't you guys a bunch of oil producers? So I think that they are searching for other avenues to acquire prestige. And that generally for the Saudis involves throwing money at it.
My amateur take on this, off Lacey and off your work, is the basic idea that these are tribal clans, tribal families, whether it's United Arab Emirates, Kuwait, the originality of the experiment in Jordan, etc. Give us an update on the power structure of the royal family in Saudi Arabia. Does it harken back to Faisal, or is it something new?
So I think it's kind of a combination of both in effect, because the Saudis have always looked for ways to show their prestige. And so way back when you had, Abdulaziz ibn Saud, he would basically, before he had oil, his way of showing his kind of rule and affirming his rule over the various tribes in Saudi Arabia was to go around and basically promise them stuff. So people would show up and they'd ask for things and he'd promise them, and then they'd have to show up at his treasurer, and the treasurer would have to dole out the money. And before oil, there wasn't that much money. So as soon as it was gone, he'd kind of pack up and slink away. But still the Saudi king would kind of keep promising things. Well, now they've got tons of oil and tons of money. And so they're promising things, in terms of going out and trying to acquire big time footballers or do this deal with PGA, which is essentially going to allow them to kind of bankroll this commercial entity for golf around the world. And it's basically a way of ensuring that people don't say bad things about them, but also ensuring to their people, hey, look, we're doing all this great stuff, and we're behind it, and we're funding it.
And none of this is new, as as you've illustrated there, China tried to do this with football. It wasn't very successful. Russia's tried to do this in various ways, to use sport as a vehicle to basically achieve certain goals, whether it be the Winter Olympics, a Formula One race, World Cup for football. And I want to understand from your perspective, what would success look like for the Saudis? What does that actually look like?
That's a good question. I think success it's winning. So their sports teams have to do well. I mean, remember, there was a whole big controversy about the Saudis trying to acquire a football club in England, and then they didn't get the one that they wanted, so they got a lesser one. So they've got to do well, but they've also got to kind of make money out of it. So even if they don't win, it's not so much about winning. It's more about, being on TV and getting that prestige and people kind of showing them deference. They're big time. People get invited to all the big events and they show them on camera and they, say good things about them and nobody says anything bad about them. So this is a way of kind of ensuring, that Khashoggi thing that happened back there, no one remembers that, because now we've got, Rumayyan at the center of the PGA golf tournament, and MBS can show up to whatever football game he wants, and they'll show him on camera and say, if not good things, at least they won't say bad things.
Are you expecting the West to close their door to this?
Well, I do think that there's going to be pushback, but money is a really powerful motivator, and it's very hard to say no when there's a deep pocket here. I mean, look at PGA, and as long as there isn't any kind of major human rights issue that pops up, of course, I do think that kind of thing is inevitable. There will be another big human rights issue that comes up. And the issue will be, will these leagues be able to say, no, we don't want your money anymore? Or will they say, oh, well, we do want your money, we just want you to be quiet?
Ellen, you're away from what Ed Morse does, Jeff Curry, and the rest of the bandits in hydrocarbon analysis. What's your price barrel of oil that you think the royal family needs in Saudi Arabia? Do you have a Brent crude price that gets it done for them?
I think that anything above, 60, 65 is getting it done for them. They don't need to cover their budget with the price of oil. So I know the IMF says, they need $80 or $85 oil to cover their budget. That's not how the Saudis are thinking. They don't need to cover their budget with oil. They can, they can take loans. They've done that. And not necessarily that they have other sources of revenue. I think they would love 80 or 85 in order to keep expanding their investments and keep having more money to just throw at these prestige things. But, to be perfectly satisfied, I think, honestly, they're fine with 60. They can make it even at 40 or 50.
And just to be clear on the record, Newcastle United is a lesser team. Is that right, Ellen?
Well, I'm not really up on my British
that's what I heard.
Football teams.
That's what I heard there, TK. Ian Shepardson at Pantheon Macroeconomics.
While you were away, he was with us. I tried.
I'm pretty sure they tried to buy Manchester United, right?
Yeah. Well, Ellen had to wait to come on because my soccer talk was so lame while you were gone. Bramo really helped.
She really elevated the chat, did she?
We had on Ian Shepardson at Pantheon, and we were tying it into Saudi Arabia's investment with the Newcastle United and was it fourth place? The wonderful fourth place finish.
Secure Champions League football, yeah.
It was great. But, my question is to the two of you, we got another 15 minutes with Ellen, I think. I'm kidding.
I think we got 50 seconds.
You and I got to talk F1 racing and Aramco's investment there.
Ellen, well, thank you.
Ellen, thank you. That was brilliant. Learned
that
a
was
lot.
great.
Yeah.
You see Max over the weekend? Max Verstappen?
Yeah. Yeah. It was awesome.
Coming to the pitch just to go
so
round
happy.
And get the fastest lap.
I don't give a damn about this. And for years, Ken Pruitt said, Tom, watch F1.
The late,
and you got
Ken.
me into this. And I love it.
Ken tried, and I'm pleased finally you've started to get into it.
I love it.
Should we get Max on the programme? Let's do that.
I think
we get Verstappen on. Yeah, why not?
Simon's killing it. Simon's just killing it, getting this.
Very cool. Anne Maletti of Allspring on equities. Coming up shortly. Equity futures, negative 0.5% in and around session lows.
There can be the economic health, there can be the economic recession, but what about the earnings recession?
There becomes risk when valuations get so stretched. Money is not free anymore, and I think there's a catch-up that has to come.
We think if there is a slowdown or a recession, the credit spreads could widen.
We've seen a big credit shock, and we're going to continue to see that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Bramo, she's a toxic brew. She's up in Tupper Lake on some portage on the Racket River. Jonathan Ferro returns, and what he returns to is a conversation on the path of inflation in this week of a jobs report. Well, we heard from Jim Bianco there on Monday. John, what we heard from Tom Zatoris of Strategas here moments ago, the diss of disinflation, where inflation comes down and then sits there.
TK, what Tom Titsoris just said in the last hour is phenomenal.
Yeah.
He thinks that inflation expectations are bottoming for the cycle. He thinks inflation's going to be a whole lot stickier, and even with a recession he's anticipating in the second half. Now, as for that recession, what recession has been the conversation in the equity market, because the surprise of the year so far has just been this monster outperformance in equities. Nasdaq up 40%, S&P up 16%, and not just tech. Take a look at, say, Carnival, Royal Caribbean, Norwegian, the cruise
Service
lines.
sector.
Flying.
Resorts.
Take a look at what's happening with home builders. Up 40% year to date on the
Amaletti's
S&P.
building
Huge.
7,000 square feet outside Milwaukee.
How's that working out?
It's great. She's got an entire room. It's a Bloomberg room with 3 terminals.
And Milady coming up very shortly. Looking forward to that conversation. TK, these are big, big moves year to date, and this Federal Reserve is starting to talk about more hikes.
And it wraps around the non-call of the last 6 months as we begin Q3 here in earnest on this Wednesday, and that is the recession call. I wonder what the disinflation does to recession calls around the world. What does it do to China? What does it do to a beleaguered United Kingdom, except I'm told London's booming?
We have a recession in manufacturing. We don't have a recession in services. How those two converge is a big debate. Mislav Matekrov at JP Morgan, together with Marko Kolanovic over the last couple of months, they think services converges down to manufacturing. That ultimately you get the broader
slowdown. That's what
slowdown.
Rosenberg is, and you get a legit
Other people say the same thing.
Add to Hyman in this hour. Global Wall Street, stay with us. We're thinking 8/17/18.
We're trying to drag him in
we'll
early.
Get to Edward Hyman.
We're trying to drag him in
well,
early.
You know, he's great. Well, I'll explain who he is later. But what you need to know if you're not part of Global Wall Street is Ed Hyman is who the adults lean forward to, and he's been with your guys at JP Morgan looking for disinflation.
We get some services data a little bit later this week, get a ton of jobs data too, ADP, jobless claims, JOLTS, payrolls on Friday, all of that going into next week. CPI next week, Tom, JP Morgan earnings too. So bank earnings and earnings more broadly kick off in the next week or so.
While you were away, the theme that I had with Bramo.
You've forgotten Lisa's name now.
You know, it's been a whirlwind here. Greifeld saved the day. We had to talk crypto. We don't have to talk crypto with Milady, do we?
No, we don't. I don't think Anne wants to talk about crypto.
Anyways, Bramo is gung-ho on the earnings season. I believe she will come back for it. And it's amazing how I don't know what's going to happen with revenue dynamics and earning dynamics. Forget about the banks across everything.
Yeah,
I just don't know.
I can't believe we're in July already, Tom.
Do we do a data check?
Let's get to equity futures right now on the S&P. We're negative by 0.5%. Touch softer, not a big deal. Yields a touch higher by a basis point. Tom, 386.64 on a 10-year. A lot of focus on the front end of the curve. We've added more weight into that. A bigger yield, a high yield over the last couple of weeks. 4.92. On a 2-year, we're down a couple of basis points there, but certainly repriced higher. If you think about where this 2 year's been, and I can work it out on a Bloomberg for you very quickly, we were north of 5% in early March going into the SVB fiasco. We dropped as low as 275 over the last 12 months. That's the 52-week low, Tom, back 12 months ago. But following SVB, we dropped to about 350 at the lows following the bank malaise, and we've added 100 basis points plus back into the 2-year. 140 basis points.
The 2 years extraordinary. I'm going to bounce that off 105 basis points, 210 vanilla spread. We're out to 110, John, even rounded up 111 basis points, 1.11 percentage points difference with a 2-year and a 10-year. I don't know how normal business gets done with that, John. I just, you know.
Do you actually think that makes a difference? Do you think people are sitting there seeing that and they're saying, you know, I'm not going to do X, Y, Z because of that?
I think in business investment, it makes a difference because of the oddities here. And it's the bet of not what the 2-year will do, but what the 10-year will do. I don't hear much talk about will the 2-year yield come plunging down.
And Tom said 3% in the last hour. He said you can come down to 3.
Yeah.
But that's it. calling it a different kind of cycle.
What we're going to do is recalibrate here on Q3, and we can do this on value, a beaten up phrase, with Anne Maletti, Global Investments Head of Active Equity at Allspring. And of course, this is the entire strong excellence and wisdom out of the last number of decades in her Wisconsin. Anne Maletti, thank you so much. The first 6 months of the year, let's move on. How do you recalibrate here the value proposition?
Well, Tom, it's an interesting time because no one expected what happened in the first half. And so I would say, look, at Allspring, we are looking forward and thinking about where investors should be. And we're sober about the future, knowing that there's a lot of signals that signal a possible recession. That being said, we also know that on the equity side, what's important is the time you spend in the market and not trying to time the market. History suggests that if you stay in the market through cycles, you're going to do great. And that's what we're telling our investors. So we're trying to be tactical around what we invest in and really think about stock selection.
There's all sorts of research that says mid-cap, cycle after cycle, are a place to be. Okay, yeah. I'll buy your idea that mid-caps, not large caps of the Glory 20 stocks, is a place to be. But on an innovation basis, are there Apple computers within mid-caps?
Well, as you know, Tom, Apple, NVIDIA, all of those stocks started off as mid-cap companies. And so what we like to do is try to find the innovators, the winners, the big companies that are going to be the next big cycle players. And, there's a lot of those in the mid-cap space. That's why it's so interesting to us, especially with the risk reward where it's at today, where you've had those really large cap names. And again, it's really just a handful of really large cap names that have accelerated and are trading at really high multiples. And so, the risk reward may be less favorable than you can buy some of those mid cap names, much lower multiples. Still great opportunities out there.
And these big moves elsewhere, we've talked about them through this morning. We've discussed them over the last several weeks. The cruise operators, the cruise lines just absolutely flying, the home builders on the S&P 500. What are you telling clients about some of those moves? They are monster moves year to date in just like 6 months. Home builders up by 40-something%. What is that all about?
A lot of it has been about demand, supply and demand. Jonathan, as you guys know, you talk about this all of the time. Travel demand has come back really strong. Housing demand is still out there. Despite what we all see with interest rates, there's a shortage of housing. And so housing supply is low, demand is strong. And so it's not too shocking to see that demand and those home builders are still doing pretty well, even in this type of economy. But I think there's the balancing act that we have to play. Again, those names have seen really good returns. Is that the place you want to be over the next 6 months? Those are the things that we're looking more closely at.
The thing I'm trying to work out, Anne, is just how relevant the rates debate is to the equity market performance at the moment. As you've discussed, tech's flying, rates are at 5%. As we've just mentioned, there are reasons for the home builders to be up 40% year to date, but this is happening with rates at 5% and mortgage rates, of course, much, much higher. And as we know, that's because ultimately people are on 30-year mortgages and they've got 30-year mortgages that are not at 5, 6, 7%. They're much lower than that. And I'm not jealous, of course. Of course I'm jealous. But that's a story for another time. I'm trying to work out what is the relevance of 5% interest rates to the equity market at the moment, given the performance we've seen across the equity market.
I do think it's relevant, Jonathan, and that's why I would call myself more of a sober bull at this point. There's risk in the market. It's clear that there's a lot of risk in the market. I'm paying attention to the bond market. I'm paying attention to a lot of the economic data, not all that suggests things are great out there. I live in the Midwest, as you all know, and my friends, my family are all dealing with inflationary pressures every single day. So it's pretty sobering out there. I also have lived through, a couple of decades of the equity markets where you've seen signals and signs. 6 to 9 months in advance, where the market still goes ahead and rallies, tries to bring investors in, and then all of a sudden you see where the real pain gets created. And so we're cautious, but I think it's about stock selection at this point.
Where's not the value trap? I mean, on a sector basis, I'm thinking energy, consumer, whatever. Where's the value opportunity that is not a value trap?
Yeah, Tom, it's a great question, and you were talking about energy early on this morning. That's an area that hasn't gotten a lot of love so far this year. Obviously, if we go into recession, that's going to be still a tough area to play. But again, the supply has really been cut back. There's more talks of supply being cut back. That could be more interesting as a longer term play. Healthcare, again, hasn't gotten its fair share of love. It really hasn't recovered well since the pandemic. And there's some real good values within healthcare. I would even say, selective REITs out there. I know real estate is a tough area to talk about now. We're not loving the office real estate space and some of the retail space, but there's a lot of other good real estate space in the REIT sector for equity investors out there. But it's hard to limit just to a few industries, because as you look down cap and as you look in those areas, there's been a lot that has been ignored. And we just saw that broaden out in June where, small cap finally got a little love. Value finally got a little love. I think growth and value, were treated pretty equally in the month of June. And small cap rallied just as much as the S&P did. So you saw some broadening out, but still not every name really, saw the appreciation it probably deserved.
Let's see if it continues. And thank you, Anne Maloney there of Allspring on the equity market. If you are just tuning into the programme, welcome to the programme, the S&P 500. Right now, equity's a little softer. We are negative 0.6%. That's a session low, TK, as we go into a conversation with Ed Hyman of Evercore. A conversation this morning really kicked off, I think, by Tom Tsouras earlier in the last hour, talking about the lack of disinflation he anticipates in our future.
In the U.S., the surprise here, and Hyman's been great on this, is the disinflation in place, and we'll talk about the disinflation as well. John, this moments ago from Tom Rees off the London desk, this is J.P. Morgan, modeling out an unanchored 7% by the BOE, which I can't get my head around. And the key word here from Tom Rees is the idea of it becomes unanchored. There's that risk there that a central bank loses a little bit of control.
You go out to 6, you go out to 7. This might not be biting in a major way right now, Tom, but slowly you start to get more and more remortgaging through this year. And I talked about some of the data from UBS and a team here at Bloomberg breaking some of that down. 1.4 million due to remortgage this year in the UK. There will be more again next year, Tom, and then you start to see the bite more and more. That's just the illustration, the real-life illustration of the lags in policy, so to speak.
Alan Monks mentions lots of caveats. I get that, but maybe it's lots of caveats second half 2023. How blind are we right now? That's something I want to talk to Ed Hyman about.
Well, let's go back to where we were last year. Jackson Hole, August 2022.
8 minutes, freezing cold.
Pain. Chairman Powell's talking about pain. Here we are. Where's the pain?
Oh, I think
we thought major market pain, major economic pain, and all everyone has done is push back that call. Just push it further out.
I think
push it further out.
The fancy people have done well, but there's half of America that's got the.
Oh, that I agree on. That I totally agree on.
I do.
But more broadly at the aggregate level, we were talking about recession and bear markets, and here we are, close to 12 months later, talking about anything but. Ed Hyman coming up shortly from New York. Equities near session lows. We're down 0.6%.
What we don't want people to do is to begin chasing this rally. We do see some storm clouds on the horizon. We do think that the risk of recession has risen. I do think that the Fed is going to continue hiking rates. Yes, we've had a very good run in risk assets, but I wouldn't chase this rally too much. I would stick to your plan, stick to your asset allocation, rather than moving things around.
David Leibovitz there of JP Morgan Asset Management, acknowledging how many people missed the rip-roaring rally of 2023 so far year to date in the first half at a couple of days of July. We've got an S&P 500 up 16%, and Nasdaq 100 up close to 40%, and futures this morning slightly negative. We're down 0.5%. TK going into payrolls on Friday, CPI next week, some earnings next week, and a ton of data in between.
And still we're modeling 2% growth or whatever. You know, even Ed Hyman got the recession call wrong. You know, it's out there, and it's like
we're just pushing it out.
We're pushing it
further out.
That's
Although some people might say that technically, 2 quarters of negative growth, maybe that was it.
Yeah, that
although we can have a
like
debate another time about that. Sure.
Yeah. Did you look at Ed Hyman's research note he sent over to us?
Ed doesn't send me his research. It's too expensive for me.
It is. It is.
It's charging so much money that I can't read it now, Tom.
I had a paragraph in an agreement with a hedge fund once. True story, folks. Didn't work out. It didn't work out. But there was a paragraph on page 42, whatever, that said, I must have 24/7 the research of Sanford Bernstein and Edward S. Hyman at ISI. That was literally written into it, because that's how much in the old days, and frankly the present days, you have to have. Every leader in the world, folks, wants to get this research, and they live to get his black marker on the white cuff of their sleeve.
Explain that story. What's that mean?
He sits at a table.
And then throws pens at people.
They've got like 42 floors on Madison Avenue, wherever it is, Fifth Avenue, excuse me. And he sits there at a little table, and they give him the note, and then he takes out a black pen and marks it up like this. One day he ruined one of my shirts.
How much editing does Julian Emmanuel get?
He gets none. He's lucky. He's over in the cheap seats with the hockey players talking. Joining us now for a substantial amount of time this morning, we're thrilled to bring you the chairman of Evercore ISI. Ed Hyman joins us for a mid-year update. I want to do a little history here. John's got like 6 serious questions. I'm calling the October bottom the Ralph Ancapora, Edward Yardeni bottom. Many other people were out there as optimistic, but Ed Yardeni absolutely nailed the bottom. You basically gave him his job. You were at C.J. Lawrence a million years ago. I read your research worshipfully. Right. And you went out the door to set up your own shop, and Yardeni replaced you. Is that true?
So I had to deal with my boss then, Jim Maltz, who ran the firm, that I wouldn't leave until we got a replacement. And so Jim came in and said, Ed, you can leave. I said, oh.
The inbred optimism that Ed Hyman has and Ed Yardeni has, what does the Gloom crew get wrong here about the need to understand America will persevere?
So I think we're going to have a recession. And I follow Ed Yardeni closely. And I just read his piece over the weekend where he's doesn't have a recession. And I've been through this more times than anybody on your show. The yield curve works, and the yield curve is really inverted. And then if that doesn't do it, you have a contraction in the money supply, the most since the 1930s. And then you have a significant increase in rates plus QT. And so Mike Tyson could get you with any one of those, much less he's got 3 shots. And so I just have to add that from when the yield curve inverts, it can take 18 months for the economy to go into recession. And just before it goes into recession, it looks great. It's a very humbling business. And Tom, I got to say, I have not been forecasting a recession for the past year. I fought last year the 2 down quarters like crazy, and I have the 3rd quarter down, which seems too aggressive. But I'm pretty flexible, but I'm sure it's coming.
Does this have a pre-08 feel to it in that regard?
Not really, just except for the yield curve. But the
well, that's what I meant specifically.
Oh, for sure on that. And it's playing out pretty much like that. But you don't have the housing bubble. You don't have something that would cause a severe recession like we had in 08, 09.
Where are you on the inflation backdrop at the moment? We had a guest in the last hour or so who suggested that inflation expectations are bottoming for the cycle, that ultimately inflation is going to be sticky and a recession won't address it.
Yeah, so I'm on the other side, big time. So I just looked before I came over here at gasoline prices, which have a big influence on inflation expectations. Inflation expectations have come down significantly. But they also are influenced by gasoline prices. And the futures have gasoline prices going down another 10 cents in the next 6 weeks. Not a big move, but not up 20 cents. And gasoline prices are where they were 15 years ago. So inflation is coming down around the world. They just reported this morning the PPI for the Eurozone was now in deflation, minus 1.5%, which you reported. And then last week, the Spain CPI went below 2% for the first time. So I try and connect the dots as best I can. And it looks to me as though inflation is really going down. And with that policy backdrop I mentioned, it's going to keep going down.
Well, let's build on that. So we've got you on growth, got you on inflation, build on the policy backdrop. Most people anticipating now the Fed goes again this month.
Right.
Maybe goes again after that. Where are you and the team now?
So Krishna Guha does our Fed work. He has one more and done. And so that's what I would follow. At this point, the one more is baked in the cake. I think anything from now is a mistake. They're just creating a deeper recession or the more likelihood of a recession. But at 5.25 with the bond yield at 3.80, they're pretty much done, and inflation's slowing. The Fed hiked rates in March of 2022. And at that point, inflation had already gone crazy. And they were still doing the transitory. And then
they were still doing QE.
They were still doing QE. And so as I can tell, by the time they cut rates, inflation will be so far down, it'll make them look a little wrong-footed again.
Over the years, you've been considered for a Fed president, certainly as a Fed governor as well. Ed, what did this Fed get wrong? Was it too much communication? Were we advantaged with the silence of Greenspan?
I think it's very difficult to have 300 PhDs make a forecast. Not buttering you up, Tom, but I'd rather have you make that forecast than 300 PhDs.
Yeah, Mike said I can't do that. Mike walked in one day and said, "Tom, I don't need any forecasts on air. Continue."
And so I think it's just part of the stickiness of the decision making.
It's by committee.
It's by committee, and I also tend to try and always go where the puck is going, to put it in your terms. And boy, the evidence that things are slowing on inflation is really pretty awesome.
We're going to have you back, but you hired Gretzky. How's Julian Emmanuel doing? To me, like his weekly note during earnings season is the most valuable thing that comes over the transom. And what I want to say is this guy captured the equity market lift. Maybe not all tech. He didn't tell you to buy NVIDIA, but is Julian Emmanuel doing okay over at the shop?
He's doing great. So we have an open office. I learned from Mike Bloomberg. So I have a desk. Then I have Rich Ross, and then I have Julian Emmanuel. And we're within, I wouldn't say shouting distance, we're within talking distance.
Is he talking about a second leg of the bull market like Ed Hyman nailed? We've got to be quick here, but second leg of the bull market, all 76?
He's just cautiously up.
There you go.
Cautiously up.
They separate Tom and I in the office. Do you know that?
I didn't know
that.
That
We're not allowed to sit next to each other. But we can throw things at each other. And it works out pretty well.
Yeah, but it works out because we got interns that help us. They just go between.
Good to see you, Ed. Ed's going to stick with us. Ed Hyman of Evercore. I'll take you through the opening bell in about 30 minutes from now. From New York, this is Bloomberg.
Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Thank you for your huge response here as we stagger into Q3. Lots of interesting topics and even some new things invented in the last 72 hours. We'll address that mightily in this. Make a joke, holiday lengthened work week. Boy, does this feel like it. We are compressing everything into Wednesday, Thursday, Friday. Michael McKee is going to be medicated after he speaks to us here in this block because tomorrow's an impossible amount of data. Mike, it's amazing how we get all this data dumped on us Wednesday, Thursday, Friday.
Yeah, we're going to compress the week, as you said, Tom, and it is going to be a lot of data that's going to matter to people because it's all about employment this week, and that's something the Fed is really focused on. The most interesting number of the week, besides the jobs report, is probably tomorrow's JOLTS number because that's, of course, what the Fed's hung the idea of a tight labor market on. So we'll see if job openings go down and the quit rate goes down. That'll be interesting. And, of course, we got also claims tomorrow and ADP. So you're going to be busy, or, well, I'm going to take over a lot of your airtime, put it that way.
I mean, we've got the 10 o'clock data today. It's sort of Monday, durable goods, factory orders, and that. Enlighten us on Ward's total vehicle sales sometime along today. How does the auto industry work into the McKee calculus?
Well, autos go into GDP on sort of the unit sales basis, not in the retail sales numbers, dollar volume, because they're counting what goes out of the factories, dollars, and they also count the orders from rental car companies and things like that as business investment, so they're not quite in the auto department. But it does matter a lot because there's an awful lot of spending on autos. Right. We did see a slight decline last month, but we'll see if it picked up this month as people want to go out and get convertibles to ride around in the sun.
Mike, I'm going to go to Ed Hyman here and finish a conversation. He's got a busy day ahead of him. And before I do that, Mike, what is the dynamic here on non-farm payrolls? Ellen Zentner at Morgan Stanley says we rapidly go under 100,000 non-farm payrolls. I find that almost unimaginable. Is that possible?
Well, it's possible. I would say it's unlikely that it would happen that fast. That companies would altogether decide at the same time to stop hiring, but it is certainly possible. I think more likely is that it gradually peters out. At least that's the Fed's scenario. But to get to the numbers they've been talking about in terms of unemployment, et cetera, we're going to need a rapid move down for the second half of the year, or we're going to still see unemployment below 4%.
Michael McKee back with us here in a number of minutes to really get you prepared for the jobs data, ADP and claims tomorrow on the same day, not Wednesday, Thursday, and then to the Friday jobs report. I continue with the gentleman from Evercore ISI, Edward S. Hyman. Ed Hyman, I want you to talk about the hallmark of your work back to C.J. Lawrence, and that's the granularity of studying data. Does the granularity of freight rates, the Greenspanian data study, still work in a modern high-tech age?
Works even better.
Why?
Because there is so much high-quality data now, generated by computers. And so I really think that my success in studying the economy and forecasting comes from being more granular. So the Fed seems to look at one data point that comes out, like the supercore. And I've looked at maybe 20 at that point. And like what Michael was talking about on the employment number, there's a lot of data points, and they're generally pretty darn strong for employment. So we're estimating 220. Alan Zentner, I think, is terrific, but I don't see that sub 100 number or a really low number in the data that we get so far, like unemployment claims, or we survey employment agencies once a week.
I look at the data, and to me, the hallmark here across the decades is we used to aggregate off the revolution of 1947, the way we bring in macro data. Do you at Evercore ISI still aggregate, or are you partitioning out now for different quintiles, deciles, or John Edwards' two Americas? Can you aggregate still?
Yes, but you have to take into account the different pieces. And right now, the manufacturing sector is pretty weak, maybe in recession, and many other parts of the economy are doing quite well. Services, like over the holiday, July 4th, and you also have home building is now actually coming back. It's been very strong and has accelerated in the past couple of months.
Right. You took a Kufal-Nasser slide rule from Texas to MIT. I don't know if you studied with Solo there after 57 productivity, but explain the Evercore ISI view on America's productivity given the new technology overlay. Are you an optimist or not?
I'm an optimist, but it's not in the numbers. One of the phrases is productivity is everywhere but in the numbers. But what you do has enormous productivity. and what I do, frankly, has enormous productivity. But we're not getting it, period, right now in the numbers. Employment's good, but the economy is still slowing, I think.
What do you think about the frenzy gloom crew? Particularly, they come out every Friday. Friday seems to, you publish for the weekend and that. But we've always worried back. Think of '87 or the August of 1998. The worry, the angst has always been there, but there seems to be a different character to the gloom now. How do you respond to that?
So, the forecast for recession was virtually unanimous a few months ago. And now there are many people going to a non-recession forecast. I am the most bearish I've ever been on the economy without being in a recession. And it's because of the yield curve, the contraction in money, and QT at the same time they're hiking rates. That blow hit to the economy is going to cause a recession, but it doesn't happen overnight.
So can you own stocks, given the statement you just made that you're the most gloomy you've ever been? Are you all in cash, or can you own equities and participate?
So I mentioned, I think 3 times now, the 06, 07 going into 08. And the S&P went up 20% and peaked like 2 months before the Great Recession hit. Mm-hmm. Boy, is it tough. And so right now, I think the economy is doing well, and the stock market is going up. The technicals are good. And so I think we'll keep going up until it looks like we're about to hit the recession. Mm-hmm. And that's not today.
I got 2 minutes left. You're the only one who hasn't moved to Florida. You are part of the New York City fabric. Explain how you view the future of this great city.
It's very tough because so many people are moving to Florida. But this city is so vibrant. Just being here with you, which I know you love the city and all the institutions in it.
Never bet against New York. That's the only reason I got this job. I said that to the mayor at the time. He said, "You're hired."
But anyway, as long as Mike Bloomberg is here, right. I think we're here.
Okay, what are we going to do with the Fed? One final question. What's the Fed, Ed Hyman Fed strategy here forward?
So they're going to hike one more, and then they're done.
When do they cut?
Probably, I think toward the end of this year, but maybe early next year. But I can look down the street. I can't see around the corner. But when I get to the corner, you'll have a much better idea.
That's the smoke from Canada. That's why you can't see. Ed Hyman, thank you so much. I know you've got a run here. He is with Evercore ISI and truly iconic on the street. Someone who reads the market economics of Ed Hyman is Michael McKee, and he rejoins us right now here with a brief on the labor economy. John, ADP claims tomorrow. Do I care? Michael, do I care?
Claims you care about because of the big surprise last week when we dropped so many and went back to a previous level. So does it go back up again? And as Ed was just saying, when you're looking to see some sort of weakening of the labor market, you're looking at jobless claims, and we're just not seeing it at this point. The ADP numbers are always traded on, but they don't matter all that much. They even say they're not a data point that's going to forecast the jobs numbers. So, we'll get some action on that. But we could, in theory, see more action on jobless claims if they went one way or another to a significant extent.
What are wages doing? And, Ellen Zentner mentioned this, and Ed Hyman has a killer chart. We protect the copyright of all our guests. Get that from Evercore ISI or Mike McKee. But Mike, on wages, do you look at wages or inflation-adjusted wages? Where's the best value Friday at 8:30?
Well, you're going to want to look at the hourly earnings, which are not adjusted because, of course, nominal spending, nominal wages are the way you're going to be able to compare those. But it is average hourly earnings that the Fed is looking at to see if we're starting to see some sort of progress on the idea of companies having to pay up for labor. And if that's comes down some more, they will feel better. We have seen inflation fall below wages and earnings, particularly for the ECI. And that is good for the American public, for people who are getting paychecks. Yeah. But it doesn't mean that we are seeing a decline in the inflationary pressures. And what we're not seeing, as Ed was just saying, is productivity that would make up for the higher wages. So right now, that's something that has to come down, or productivity has to go up.
But what about the technology overlay? Do you believe, and I say this, folks, with immense respect for Mike's encyclopedic knowledge of the data and what it represents. A la Paul Romer, the Nobel laureate on technology, does our present clumsy math of productivity capture what technology is doing to this nation?
There's a lot of debate about that, Tom, and productivity is hard to measure, especially with technology and the way we use it. But the one thing you have to note is that for the last decade or so, most of the technological improvements that we've seen have been in the leisure category. Your phone, the fact that you can carry around all the streaming TV in your pocket kind of thing. What we're waiting for is something that really affects the workplace, like computers did in the 1990s. Now, maybe that's going to come with artificial intelligence, and that does seem to be moving forward quickly. We don't know exactly how it will be adopted or how quickly, but if it is anything like the 1990s, we could see a nice run of productivity increases.
Let me do the data here right now, and we're going to come back with Michael McKee on a really important discussion fermenting over the weekend. Futures down 0.5%, down 24. I'll wait to the tape here in the last number of minutes with the VIX, not a 13, the VIX out to 14.48. The S&P percent move, 0.54%. We say good morning, and on radio and television, a really eventful Wednesday, Thursday, Friday. I really want to look forward to Friday and the 8:30 jobs report. We'll go beneath the headline data, but far more. We're just loaded with data forward, including in an hour and 20 minutes, Michael McKee in Washington with a look at our durable economic data. Michael McKee, over the weekend, and this goes to my book of the summer with Olivier Blanchard, is this raging debate of R-starred. Now, we're not doing, it's July, Mike, we're not doing wonky difference equations or that, but I want you to frame the two camps. John Williams just reaffirmed we go back to where we were, some form of lower run rate for the economy codified by the econobabble of R-starred. Others disagree, and they're out at a new R-starred, which is elevated. Who are those two camps?
Well, first, let's define R-star. It's basically the neutral level of interest rates, which means they don't stimulate or hold back inflation. And so what you're looking for is the sweet spot, which you cannot identify except in hindsight. But John Williams at the Fed, along with the late Tom Laubach and Catherine Holston, came up with a formula to try to estimate where it is. And during the pandemic, they suspended that because they couldn't get enough accurate numbers. And now they've brought it back. And what they say is under their new formula, the way they've accounted for the pandemic, et cetera, it means that this R-star number, the neutral rate, goes back in a relatively short period of time down towards 2% or less, which means less inflation.
We're going to continue,
now,
Mike.
Is that going to happen?
We're going to, if that's going to go, we're going to see. But we will continue this discussion with McKee on the way to Jackson Hole. This is Bloomberg. Stay with us. Good morning.
We should bottom at 3% and start drifting towards 4%. Now, I'm assuming no major downturn, no kind of crisis that comes along. If the inflation rate bottoms at 3 and starts drifting higher, the Fed's going to find this unacceptable. And that 2 rate hikes that we have priced in for the rest of the year will happen, if not 3.
Jim Bianco with arguably the interview of the week, with great respect to Edward Hyman here, who we just spoke to. I'm going to codify this because it's going to be the conversation into this week and into all of July. Jim Bianco, and I will give a major shout out to the team at Strategas Research as well, are talking about, yes, we get disinflation, as Ed Hyman just codified, but the basic idea is, and then it stops. And Bianco's so bold as to say it will actually rise up as well again. That is a discussion for July, and we welcome all of you as we stagger into Q3 of 2023. Usually we'd wait with Helene Becker. I mean, the only reason we have Helene Becker on, she's with TD Cowen, is because she can get me tickets to Paris. Nobody else can. But Helene Becker joins us now on the tragedy, which is domestic air travel. What I learned over the weekend, Helene, in two instances, one with John Ferro, who actually got on an airplane and got home, is international travel is actually pretty good, and domestic travel is an absolute train wreck. You drive out of Denver, and you and I remember the horrific Stapleton International Airport with the winds going sideways, and you were lucky you could land. This is ancient history. And you're going across the fields of Denver East, and there are those teepees in the distance, which was the huge success of Denver. DEN built a stunning 27 years ago. Why can't we build new airports in America?
That's a great question, Tom. So the number one issue is space. We don't have enough space. If you think about Newark Airport, to the right you have one highway, and to the left you have the New Jersey Turnpike. So there's no place to put a third parallel runway that would alleviate some of the problem. And then people don't want big airports in their backyard. The reason Denver was able to be built is because they bought so much of the land out there that you can have, I think there's 4 parallel runways now, and I think they can go up to 6 or 8. So they have the space for growth. Most of the rest of the country is built around cities, and you just don't have that.
Within that, Scott Kirby of United beleaguered, I believe he called in from Teterboro. We're trying to get him on the phone. But Scott Kirby of United made clear they will do less flights out of EWR. The companies you follow, is that the future, which is they're just going to have fewer flights?
Yep, absolutely. We've been seeing that, Tom, as you know, for a couple of years now, for at least 5 or 7 years. It's going to be more seats per departure, so bigger aircraft, and it's going to be fewer departures per day. You remember, you and I talked about this. The Secretary of Transportation asked the 4 big airlines serving the New York area, Delta, American, United, and JetBlue, to cut their summer capacity by 10% because air traffic control is understaffed. And you add to an understaffed air traffic control system, then you add to that winter or summer rather thunderstorms, and you have all the aircraft have to land, especially the ones coming in from overseas, and then nothing's taking off. So you get
right.
You get those issues with aircraft that can't find gates, and the next thing you know, people are trapped.
One final question on this insanity, and I actually want to talk Graham Dodd and Cottle with you, actual adult securities analysis. Not so much who do you blame, but years ago, weren't there thunderstorms as well? I mean, I don't get why thunderstorms are now a new thing.
Right, exactly. So the biggest issue is when thunderstorms roll through the area, they're number one, unpredictable. So you don't really know where the cells are. You cannot have, because of all that metal, if there's lightning in the area, you cannot have your people on the ramp loading and unloading bags. They have to come in. You can't refuel. So they have to come in. So that's, to your point, that hasn't changed. But what has changed is the entire system is just overtaxed, and it goes back to years. It goes back decades. The system has been underinvested in, and that's infrastructure. It includes airports, it includes government,
right,
and it includes airlines.
Let's talk securities analysis, buy, hold, sell. Helene Becker, on, say, to pick out United Airlines, I did a log regression of United Airlines back to 2008, where they cratered in the Great Contraction. Great. They could go up 100% off that log extrapolation out based pre-pandemic. Do you envision these airlines going up 50, 80, indeed 100% in the near term?
Off the 2008 basis? Yeah, there's no reason why they shouldn't. Maybe not 100%, but certainly doubles. From here. I mean, it's not going to be as robust as it would have been without the pandemic, because with the exception of Delta and I think Alaska Air, everybody else issued equity. So if we thought they could earn, like United, take for example, our best idea for 23, if we thought they could earn $13 a share at the peak. At a 10 multiple would be 130, but now you have to adjust for the increase, in shares outstanding. So 13 becomes 12 and 130 becomes 120, and the stock's at 55-ish, 54. So no reason why it can't go up from here, especially given the fact that we think we're in a multi-year growth phase where you're going to have these issues. These are not issues that are going to be solved speedily. If we're short 3,000 air traffic controllers and we only train 500 or 600 a year, that's a 5 or 6 year problem right there. So curious to what Scott will say. But it's kind of problematic.
But Helene, this is important because I remember I treasure my conversation with Robert Crandall, American Airlines and all that he did and the history of aviation, the romance of what Helene Becker covers. Great. The bottom line is, have they found a new maturity of persistent cash flow, or are the group of planes, are they still sharks where they boom, they bust, they boom, they bust? Is it a new regime?
No. No. I mean, I don't know the answer to that specifically. I don't think I would never have forecasted the pandemic, right? And I never, in fact, I famously said that in one of my reports that you can't shut down the world. And it turned out we did, and you could. It's just turning it back on is not that easy. And I think that's a big problem. We stopped figuring out how to make this work. And the fix is a multi-year fix. But in the interim, there will always be shocks to the system that will cause the earnings to decline, will cause losses, will cause airlines to go bankrupt again. But I think in the main, because of all these infrastructure issues, a lack of OEM deliveries that our good friend Kai von Rumer, my colleague at TD Cowen, talk about all the time, the ATC system that we've talked about, you add all those issues together, plus you have 10,000 at this point pilots retiring in this decade, and it's hard to replace them and so on. So by the time you're done with all of this, it's really problematic because air travel is just going to get more expensive.
Real quick here, Helene, you get to breathe the same air as Kai von Rumer. I mean, he's the giant for all of us within airline transportation security analysis. Is Kai von Rumer optimistic on the future of Boeing, whether they're out of Seattle or Chicago, or I think they're moving to Washington this week? Is he still plus on BA?
Yeah, I think so. I think it's one of his top picks.
Okay, Helene, thank you so much. Helene Becker there with TD Cowen on an upper. Thanks to all your anecdotal comments over the weekend on domestic travel, and I've had a couple very worried messages about Bramo, and I'm really not sure which airport she's in, but it's how it is. They set up the airports and there's no place to lay down because they don't want people laying down. And so, she's got a fold-out thing where she puts it across the railings of the chair so at least the cherubs can sleep. But she's had her fair share of the domestic travel as well. I didn't think it was going to be a boring day. I didn't think Monday was extraordinary. I really was quite surprised by that. But I really got to say, where are we going to be 9 o'clock on Friday? I don't have a clue. I also don't have a clue where we're going to be, say, July 17th, after we get 3 days of bank earnings as well. There's a huge mystery to what we're covering here at Bloomberg News, and we're going to continue to bring that Bloomberg News, not only that, but Bloomberg Opinion as well, including that Bill Dudley essay last week of a Fed to 4.5% yields. We will see. Futures at -25, Dow futures at -200. The VIX elevated 14.50. I'd note Brent crude, $76 a barrel. Stay with us through the day. This is Bloomberg. Good morning.